Show the morning brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures losing some steam this morning with the AI rout rebound quickly fading ahead of big tech earnings. We've got results from Microsoft, Meta, IBM, and Tesla all out after the closing bell today. Tesla shares have nearly doubled in value since the last time the company reported earnings, a setup that usually spells high expectations for results. Meanwhile, analysts will focus on Meta's plans to invest up to $65 billion in capital expenditures this year as part of its AI growth strategy, which was well above analyst expectations.
Plus, the other big focus for investors today is the Fed. The Federal Reserve will issue its first rate decision of the year. The market very much expecting the central banks to hold rates steady. Investors will also be watching for any commentary from Chair Powell on how the Fed expects Trump policies to impact inflation and the economy.
And AI demand sending chip equipment maker ASML surging today as the company erasing all of its DeepSeek-driven losses this morning after booking orders came in at twice as much as analysts had expected. The CEO also brushing off demand concerns after the emergence of Chinese startup DeepSeek, saying lower cost means AI can be used in more applications, and more applications means, more chips. It's a big day for big tech. Three members of the Magnificent Seven. You've got Tesla, Meta, and Microsoft reporting earnings after the market close. Meta and Microsoft have invested staggering amounts of AI in recent quarters, and that return on investment will be a key theme for investors here. Of course, Meta, it was expected to be in the ballpark of about $50+ billion here ultimately in their CapEx towards AI spend. And Mark Zuckerberg, in one swift post, said, hey, expect more. Closer to $65 billion on the top end.
Yeah, exactly. The big focus is going to be on that AI spend, obviously on the heels of the DeepSeek developments that we got over the weekend. And we obviously saw that reaction play out in the market, a bit concerning here for investors, at least at face value. I think here we are a couple of days removed, obviously, from that. We've seen a bit of a rebound overall, more broadly speaking, within the market, obviously still lower from where we had started. But again, when you take a look at the fact that it's very concentrated in terms of that sell-off, I think that is a bit reassuring, maybe up until this point for investors. But the earnings picture might change it just a bit. We talk a lot about the importance of earnings season right now. We know that the growth rates are expected to cool for big tech, but very much a lot of that growth is still reliant on a handful of names. Mag 7 numbers, profit expectations, I believe that growth is just around, or expected to be around 22%. So if we see any sort of disappointment, we obviously have seen these stocks react negatively to some of their spending plans in the past. That very much being front and center here this morning, that does offer a bit of a risk here to the market's overall momentum.
Yes, and Bloomberg estimates actually coming into the start of this year, we're looking for Microsoft, Amazon, Google, and other big tech companies potentially collectively increasing capital expenditure to about $200 billion in 2025, $90 billion in incremental cap spending in 2024 through 2025 versus what we had seen in 2023, according to DWS Group, is expected to be dedicated mostly to expanding generative AI infrastructure here. But for investors, and I think it comes back to what you were mentioning a moment ago, it's really going to come back to the rampant monetization here. When is this finally passing through to the margins? Of course, for all of these companies that continue to tout these fatter profit margins that they can spell out to investors is a range that they can essentially build upon, but also normalize. That is going to be exactly what I think they're going to be graded on. And if we see any type of timeline for that, I think that is what could send shares higher off of these reports.
It certainly could. And obviously, when we talk about the tech sector and some of those larger tech giants, clearly valuations very much in question, just in terms of how far they have run over the last several months and several years, and whether or not at these lofty levels, how much that could be sustained, clearly front and center here for so many investors heading into tonight's results. Well, the Federal Reserve will make its first interest rate decision of 2025. That's today at 2 p.m. Eastern Time. Fed correspondent Jennifer Schomburger joining us now on what to expect. Hey, Jen.
Good morning, Shauna. Fed officials just reconvening moments ago here in Washington for the second day of their two-day policy meeting, where the central bank's widely expected to hold rates steady after cutting rates at 3 consecutive meetings at the tail end of 2024. Perhaps more uncertain, though, is how Fed Chair Jay Powell will use his press conference this afternoon to talk about the impact of President Donald Trump's policies on the economy and how they could impact the course for monetary policy. The president is threatening to slap tariffs on Mexico, Canada, and China as early as this Saturday, and Powell is likely to get questions on the impact of tariffs, questions he's dodged in the past. Also at play, Trump has said he wants rates to come down a lot and that he expects to talk directly with the Fed chair at the right time. JP Morgan chief economist Michael Feroli expects Powell will adopt more of a, quote, duck and cover approach at his press conference. Feroli also says he expects Powell will indicate each Fed member is using his or her own assumptions on what trade policies are adopted, while making it clear that the only thing decided at today's meeting was the policy decision and the monetary policy statement. In December, officials changed language in their policy statement to say that the Fed would consider, quote, the extent and timing of additional adjustments to rates based on the data and the changing outlook, showing less of a commitment to rate cuts than earlier in their 2024 rate-cutting campaign. In recent weeks, many Fed officials made clear they're increasingly concerned about signs of persistent inflation, citing that as a reason to move more cautiously this year. And in December, officials scaled back the number of estimated cuts this year to 2 from 4. There will be 4 new voting members this afternoon: Kansas City Fed President Jeff Schmidt, St. Louis Fed's Alberto Musallam, Chicago Fed Presidents Austin Goolsbee, and Boston Fed's Susan Collins. The Fed expected to maintain a cautious stance this afternoon, both their policy statement and in Fed Chair's press conference. Guys?
Jennifer, I'm pumped. I know you are as well. We'll be staying tuned for much more to come from the Fed later on this afternoon with that decision and the press conference. And you can catch special coverage, our special, the Fed's January policy decision at 2 p.m. Eastern Time on Yahoo Finance, followed by Fed Chair Jerome Powell's press conference that begins 2:30 p.m. Eastern Time. Well, stock futures losing some steam in early trading, a fire hose of market catalysts between big tech earnings and the first FOMC decision of 2025 could make or break the market's recovery from Monday's sell-off. Joining us now is Gargi Chowdhury, who is the BlackRock America's chief investment and portfolio strategist. Gargi, great to have you on the program here with us ahead of the opening bell, ahead of these earnings, ahead of the FOMC decision, the first of 2025 here. What is the setup? What is the market going to place the most priority on?
Good morning. It's great to be here. Happy Lunar New Year to all those who celebrate.
Happy Lunar New Year.
Yes. Yeah, absolutely. So the first thing that I think the market's going to focus today, just in terms of sequencing, of course, is how Chair Powell talks about the restrictiveness of policy rates. Obviously, of all of the meetings in the last couple of months, this is probably the least exciting. We don't get an SEP. We're most likely not going to get any moves on interest rates. But at the same time, I think the market's going to place a lot of emphasis on how Powell characterizes the restrictiveness of rates, how Powell talks about any impact of ongoing tariff discussions on the impact of inflation, and to what extent they still think that there's balance between their risks. So those are the things that market participants will be watching for. Going straight after that, I think all eyes are going to be on the large earnings that are coming out after close. Always important, but probably especially important now, given the volatility that we saw in the markets earlier this week.
Gargi, how much is at stake when it comes to these big tech results?
I think a lot. I think, honestly, what we have seen, and this isn't just about DeepSeek or any of the innovation related to that, but I think if you look at earnings growth expectations, what has been incredible through the course of 2025, expectations of earnings growth is expected to broaden out, but tech and the Mag 7 are still the dominant drivers of earnings growth. So we're going to have to see if some of those earnings materialize. So that's number one. And we just came out with our year ahead outlook earlier in January, we actually told investors to definitely continue to focus on high quality companies, but then also have an eye towards certain parts of value where we're beginning to see earnings growth come in. And we certainly saw that in financials earlier this earnings season. So yes, earnings really important, but the broadening out story is healthy for markets. And we saw that on Monday, where 70% of the index was actually up on the day.
Gargi, you also outlined three big risks and possible hedges at this juncture. What are they?
Thank you for bringing that up. Over the last 3 weeks or so, even before the sell-off on Monday, clients have been asking us around how they should be thinking about hedges as well as diversifiers away from the large cap tech names. So the way in which we're laying out the framework is, number one, continuing to focus on the expansion of other areas of earnings growth, like I pointed out. So whether that means remaining very active and nimble with dynamic factor rotation strategies, or whether that means moving towards areas of large cap value, that's one of the things that investors can do. The second one, and I think this is really important, one of the ways in which investors can especially hedge their portfolios in a rising inflation environment and a rising geopolitical risk environment is perhaps think about inflation-linked bonds, especially in the front end of the curve, as well as an allocation or considering an allocation to gold as well as Bitcoin. And we've seen a lot of flows in both the front end of the market. STIB has garnered a lot of inflows, as well as IBIT, of course, which has been a huge flow gatherer. And then lastly, I'd say one of the last things that we've been saying, focusing on, especially when tariff risks are concerned, focusing on companies, especially tech companies that are that have some energy, some tech independence associated with them. So that's another area of the market that we're telling investors to focus on.
Gargi, going back to what you just said a moment ago, when you're talking about considering allocation to gold and to Bitcoin, I guess how much should investors be allocating in terms of some of that exposure? And what does that look like in terms of trying to determine that and obviously balance some of that risk?
Absolutely. So our colleagues in BlackRock Investment Institute have actually done some work on this, and we've seen that, in a 60-40 portfolio, that's what you have. The percent allocation will, it's obviously how you think about the allocation of risk versus return. So your Sharpe ratio, so the amount of return that you're getting divided by the amount of risk, that you need that to pick up. And if you add about a 1 or 2% allocation in a 60-40 portfolio to Bitcoin, I think that you're getting some reasonably good pickup in your Sharpe ratio in that case, especially when you look at the returns over the last 10 years. If you get meaningfully higher than that, the risk associated with obviously a larger allocation than that 1 or 2% becomes too high. So that's what we're telling investors to think about. Similarly with gold, many investors actually do not have an allocation to gold at all. We think that especially in a geopolitically fragmented world, continuing to think about adding a gold allocation with things like IAU to your portfolio make a lot of sense. And again, that can be a geopolitical hedge as well as perhaps even a little bit of an inflation hedge.
So that's even an acknowledgement that it is safe to, at least long-term, weigh in or at least bring on some more risk, even if you're thinking about cryptocurrency and that even small single-digit percentage allocation for your portfolio. Is it Bitcoin alone, or is it other currencies as well that you think could benefit?
The work that we have done has been specifically on IBIT. So I want to be very clear about that, especially given that is where we're beginning to believe that investors know that there'll be more adoption, right? So the work that I was stating around the 1 or 2% is very much around Bitcoin. And obviously, we've seen a lot of flows as investors think that this is going to be something that's going to continue to have broad-based adoption. When it comes to gold, that is something that obviously has been adopted into portfolios for a very long time. Mm-hmm. But more and more, increasingly, we're finding that investors believe that this is going to be a good hedge, a good diversifier as well in geopolitically fraught times. So I think thinking about what role each plays as a diversifier or as a hedge makes some sense. And then the last thing, and I want to talk about this just for a second, because I think we're in an environment of increased volatility in the markets. we think it makes a lot of sense for investors to continue to focus on the front end and the belly of the fixed income market to generate yield in that portfolio, but also think about, instead of moving to cash, if you're worried about what earnings might bring or what further, sell-offs in the markets might bring, think about buffered strategies as a way to sort of preserve your upside and then give you protection on the downside.
Gargi, always great to see you. Thanks so much for taking the time.
Thank you for having me.
Coming up next on Morning Brief, we're going to count you down to the opening bell on Wall Street as the rebound that we've been talking about losing just a bit of steam this morning. Plus, we'll dig into ASML's results as the company shrugs off DeepSeek concerns. And we sit down with the CEO of Starbucks. He'll break down the company's turnaround. We've got all that and much more coming up on Morning Brief.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, shares of ASML having their best day since 2020 after the company reported stronger than expected results for the fourth quarter. The chip maker reported $7.4 billion in bookings in the quarter, showing robust demand for AI infrastructure despite fears sparked by Chinese model DeepSeek. Taking a look at shares here, they are up 6% in pre-market and ahead of the open here. Part of the CEO statement, the fourth quarter was a record in terms of revenue. Total net sales came in at 9.3 billion euro, and then a gross margin 51.7%, both above their guidance here. And they say it's primarily driven by some of the additional upgrades that they were seeing, also recognizing revenue on two of their newer systems. So this contributing to another, in totality, record year for the company as well.
Yeah, certainly. It's giving AI bulls something to be excited about. So we're seeing a bit of a reversal. Obviously, very different action here this morning than what we saw when you go back to Monday morning when some of those concerns were leaking into the market about DeepSeek. If you're not familiar with this company, they actually make the machines that are necessary for some of those higher end chips. So you talk about the ties here, the close ties to some of those more advanced chips. That is why it was caught up with a lot of the selling pressure that we saw earlier this week. But looking ahead, ASML CEO was very optimistic, even shrugging off some of those concerns regarding DeepSeek, saying that AI is a clear driver. We truly believe that AI is going to bring even more opportunity to the chip industry. And when it comes to their reliance on China, that has been a big concern here, or some of a concern here for investors, just given historically how much of their business has been attributed to China. But when you take a look at the latest quarter here, China had been the biggest market for 5 quarters. It's actually now second behind the U.S. And you can see the U.S. is a green on your screen right now under the fourth quarter of 2024, and the white is China. So again, U.S. overtaking China there. Obviously, could be good news here for ASML's future business when you talk about some of those restrictions and the impact that that could have on ASML down the line. That has also been one of the challenges that investors have very much been keeping in mind here when it comes to this name.
Man, lithography systems. Who would have thought? I mean, absolutely taking off here on the day. But for anybody that doesn't know about the lithography systems that ASML essentially has been putting forward for decades now, since the mid-'80s, they essentially just use light to print these tiny patterns on silicon, which is essentially how they are going about the chip production process in mass producing microchips. So that's just a little snippet of this lithography system that they power.
Look forward to more.
Oh, yeah.
We can always rely on you to be that.
We can do an explainer on lithography. Why not?
There we go. We're all looking forward to it. All right, let's stick with AI. It is the big driver here of the markets. But this morning we got an update out from Alibaba. Alibaba debuting a new version of its AI model today. Now, in a statement, the company is saying that its model is more sophisticated than the latest offering from OpenAI, Meta, and its Chinese rival, DeepSeek. You're looking at some gains in the market here this morning. The Alibaba shares up just about 3%. So again, this is known as Qwen 2.5. That is that new AI model. It's claiming to surpass very much DeepSeek V3, which really spooked the markets earlier this week. When it comes to some of that pricing action that we've seen in Alibaba over the last couple of days, they've actually been on this move higher here, as investors very much have been looking at some of these Chinese entrants here and the ability to do this a little bit cheaper. Obviously, that has been the real concern for the U.S. side of things here, and obviously has been giving some of these Chinese tech names a bit of a boost here over the last several trading days. Again, how well it stacks up to OpenAI, how well it stacks up to things like Anthropic, obviously very much remains to be seen. Lots of questions even about what going back to DeepSeek, what they had reported, how realistic that is as well. But again, you're showing Alibaba, and I think the big takeaway from me is not only the competition that we're seeing, obviously, with some of these models with the U.S. competitors, which has very much been our focus, but the inside domestic competition between some of these Chinese rivals. When you take a look at DeepSeek, obviously much smaller a company there, a much newer company than when you compare to more of a legacy company within China that I think you would characterize as Alibaba. But again, when it comes to some of that competition inside China, what this is actually going to do for pricing, that is the big takeaway.
Yeah, what was key here for me is that they are actually likening this more to what Jeff Bezos has backed in Anthropic and Claude versus, and kind of course, using what is the AI model du jour this week to compare up against to say that they are that much better than DeepSeek, but also looking at what has already gained so much prominence, at least in the form of investments from the likes of Jeff Bezos and from some of the other corporate partners that an Anthropic has been able to take on in order to produce their flagship Claude 3.5 or 3.5 Sonnet. Alibaba saying that Qwen 2.5 Max is almost comprehensively surpassing GPT 4.0, DeepSeek V3, and Llama 3.1 here. So all of this as we're hearing about more of the new models, but I think to your point, even as these new models are announced, it's more so how they're going to be able to operate in different regions, especially when there are the geopolitical spats that they're also going to be kind of drawn in as political pawns or punching bags at some point or another. Yeah. Well, finally here, let's go to a deal in the skies that didn't happen, and Frontier trying to make it happen again. Frontier Airlines, they are proposing their second takeover bid for Spirit Airlines. Frontier attempted to take over the budget airline in 2022. Spirit filed for bankruptcy in November of last year after a failed takeover attempt from JetBlue. In a securities filing, Spirit saying, quote, the company has determined, barring new developments, not to further delay its planned emergence from Chapter 11. That from Spirit Airlines here. And of course, the tie-ups in some of the ultra low-cost carriers is really to make sure that they can best position themselves as a lot of the other major carriers, especially here in the U.S., are setting their sights on premium right now and recognizing where they can extract more value from their customers. It doesn't mean that they're abandoning the low-cost customer, because there's still more capacity, more routes that they're operating versus some of the ultra low-cost carriers. But for the ultra low-cost carriers to continue to have any type of competitive performance in this market, it's going to need to, and like JetBlue is doing right now, ramp up some of the premium offerings, but also figure out, okay, where are you just going to continue to hold that baseline of customers that you've been able to service on perhaps that lower income cohort that is flying and traveling as well.
Yeah, when you take a look at Frontier's argument here for still making this happen, they're trying their best. They're not giving up. Again, this is the third try that they're going for here. And they're basically saying that Spirit is not going to be able to do this. When you take a look at the restructuring plans, they're making the argument that it's actually going to result in, quote, an unprofitable airline with a high debt load. And compare that to what Spirit is saying as they did rebuff this offer, saying that the offer that was put forward, calling the terms, quote, inadequate, calling them unactionable here. So very much they are still sticking with their plan to try to restructure here through bankruptcy. The question here is ultimately what the future of this looks like, how so many of these companies, like you were saying, Brad, are going to compete with the legacy carriers, going to compete with the larger carriers within the space, especially when it comes to pricing. Obviously, so much just in terms of the next several months, the next several quarters, a lot of that uncertainty has to do with just the macro environment and ability and willingness of consumers to spend as well, and how that could potentially delay some of these plans that we have heard from some of the leaders within the industry, just in terms of what they're doing to gain a little bit more loyalty here from their existing customers.
Yeah, and it could require some maneuvering with their aircraft fleets that they operate as well here. You might see even more of the leaseback agreements come forward, where essentially they allow someone to purchase their fleet, but then they lease them back, and that is something that they've had to navigate, especially with maintenance costs in mind too.
All right, we'll keep it right here on Yahoo Finance. Much more of your market action ahead. We've got the opening bell when we come back.
There's a live look at the opening bell at the New York Stock Exchange, and you've also got a look on your right side of the screen at her first 100K ringing the opening bell at the Nasdaq. You've got Reach Out and Read on the podium at the NYSE. Let's take a look at how the markets open up here on the day as we've got the Dow Jones Industrial Average. It is flat, just barely to the downside right now. We'll see if we can get that into positive territory, and just as I say it, it happens. S&P 500, you're seeing that down by about 0.1% to start off the day, and the Nasdaq Composite fractional decline by about 0.2% to start off today's activity. Let me populate this chart for you just so you can see the setup coming into today's activity. Past 3 days, Nasdaq Composite down over that period by about 1.3% here. And we did see a bit of a comeback here yesterday for some of those those mega cap tech stocks that certainly did drive much of the declines starting off the week. We will see how that continues to transpire. Big earnings day that we've got after the bell for some of those mega cap tech stocks, and specifically in the Mag 7. Speaking of the sector activity that we're seeing here on the day, and I mentioned technology, one of the worst laggards right now, but it's only down fractionally by about 0.3%. You've also got a look at materials. That's down by about 0.4% to start off today. And then additionally, leading the pack out in front, communication services. Can you hear me now? And utilities, that's up 0.25%. Nasdaq 100, there's a look at some of those mega cap tech stocks that we were talking about. Apple down 1.5% to start the day. Nvidia, despite a major bounce back yesterday that it saw, not enough to claw back all of the declines that we saw to start off the week. And it's starting off today here down by about 2.4%. So giving up some of yesterday's positive move here. We're also keeping close tabs on Amazon and Alphabet as well as Meta. We're going to be tracking close for some of those earnings to come after the bell. I'll ride out with a look at the Dow 30 components here on the day as you're taking a look at what looks like more green than red for those components in the Dow. With that and a deeper dive, let's jump on over to Yahoo Finance's Jared Blickery for a look at what is moving here at the opening cross.
Thank you, Brad. I want to start with the Nasdaq, which just had its best day in over 2 weeks. This is a 3-day look, so this gives you an idea of what's happened this week. Of course, Monday was that big drubbing that the market had, mainly because of NVIDIA, the chip stocks, Broadcom. That sank the Nasdaq. So the big question in investors' minds is this a one-off, or is this a resumption of the trend that we're seeing here? In other words, is the trend resuming to the downside today? It's Fed Day, and there's a lot in the mix, so I'm not going to draw any conclusions just yet. I want to show you the Dow real quickly. Here's the 3-month chart. Even though, it's about flatline today, and it's within 1%, actually quite a bit less than that of its record high. So we might see some interesting headlines along those lines later today as the day develops. And also got to take a look at yields, because we are seeing U.S. rates falling, and this is again a 3-month chart, but we are seeing the dollar up a little bit. Nothing to be concerned about, but just something to keep in the back there, as we do not necessarily want to see a very, very strong dollar. Getting to the sector action, as Brad was saying, communication services is leading early on. We also have staples that has done well over the last week since the inauguration. And I'm going to be taking a deeper dive on some of these post-inauguration moves and the reversals that we've seen, especially in the dollar in the 10 a.m. hours. So stay tuned for that. Just want to show you what's happened this week. Over these 3 days, we got communication services leading with healthcare and staples. And healthcare, by the way, really interesting to see healthcare perk up now. Not necessarily what people would have said is the Trump trade, but this is a really nice breakout we're tracking on this 1-year chart. Got to get back to the Nasdaq, and I'll put it on an intraday basis where we see Apple taking a little bit of a hit here. Meta looks like it is as well. They had been leading this week, and we can see Apple up 5.6%, so it is indeed still leading. NVIDIA down 11.9%, Broadcom down 15% this week. But all in all, we're seeing chip stocks today. We're seeing chip stocks, Chinese stocks, and Bitcoin all perking up. So an interesting mix on this Fed Day. Shauna.
Interesting mix indeed. All right, Jared, thanks so much. Let's get to today's strategy session. The market rebound losing some steam. You can see it, the red across your screen right now, following Monday's AI-driven sell-off. So is now the time to buy the tech dip, or is more volatility ahead? Joining us now, we want to bring in Abby Yoder. She's JP Morgan's Private Bank's U.S. equity strategist. Abby, how should we be thinking about the last couple of days?
Well, I think the last couple of days in isolation have obviously been very volatile. We've been thinking that, the last year was really rare, right? Like we had 2 8% drawbacks in the S&P 500, that's essentially like no volatility to a certain extent. So seeing this happen, we couldn't have guessed the reason why. Like we didn't expect it to be this, but we were expecting, volatility and a reset in valuations. That's something that's somewhat healthy. So seeing this broadening out and seeing this correction is relatively healthy in our view. I think to your question on like, does this downtrend continue? I don't think so. Like our year-end target remains 6,400. I think we're in the third year of this AI revolution. We're going to be, seeing fits and starts in terms of who's the winners and who's the losers.
Do you think it's some of those companies that have led, though, that narrative that are going to lead the pullback then, too? Because, I mean, realistically, even coming into the DeepSeek news, Apple was already down in its own correction of about 10%. NVIDIA was already slipping as well. And so the rest of the market really just kind of catching up after that DeepSeek ball dropped as well.
Yeah, well, I think, look, people sell what they own. And that was, all the narrative the past couple of years has been the concentration risk and really around valuations. So yes, I think when you're thinking about, and particularly given the catalyst that was, this week in terms of the AI narrative, that's really like, are we at risk? Does that narrative change? Like what's going on in the next couple of years? I think that's, to that point, that's why they are leading to the downside. But you're seeing the rest of the market do fine, right? Like equal weight was flat on Monday when the market cap weighted index was down 1.5% and 70% of companies were up.
What does that tell us then just about the staying power maybe of this rebound and the signs of it that we have seen, the fact that there is so much optimism still at play right now?
Well, I think the read through to that, at least for me when I'm thinking about it, is okay, you see the rest of the 493, let's call it, doing well. I think what is going on is, okay, what's happened essentially is we have AI that's just as effective at a lower cost. So if I'm a company in any other industry and I'm thinking about, okay, there was this barrier in terms of cost previously, and now that's been lowered, and now I can implement not only more use cases, but at a lower cost. I think that's the read through, right? That means productivity enhancements, that means lower costs, that means better margin profiles.
What is the timeline that investors should be grading companies against when it comes to the capital expenditures that we're going to be hearing about over the course of this earnings season?
Well, look, we're going to get some insight this week that I think is very important. And I think throughout the year, right, like there essentially annual expectations for CapEx are already, out there. Are we going to see a pullback in that? Probably not. That's not our view. So thinking about the out years, though, right, when you're thinking about growth investments, you want to think about the out years. You want to think about 26, 27. So thinking about that, I think will be very important. And how that, and the mix of that spend. Because even if that spend is the same, the beneficiaries of it might be very different.
And Abby, since we do have the Fed decision coming out later on this afternoon, obviously very much market pricing in the fact that we're not going to get any movement on rates. So clearly the focus will then be on the rhetoric and some of the statement and commentary that we're getting from Powell. How are you thinking about this risk that we could get more hawkish commentary and maybe how that will play out in the market?
Well, our view is that we don't get that hawkish commentary. I think we're still seeing signs of the labor market weakening, particularly as it relates to wage growth, right? Like that's the one thing we're really paying attention to. Also, shelter inflation plays a component into that. Obviously, it's a risk, but I think the market is really debating, like, it's kind of a toss-up. Is it 0 this year? Is it 4 this year? Like, I don't think there's really high conviction. And I think the biggest point is that we don't think we're going to get messaging that they're about to hike, right? Like, that's the important thing. Like, maybe there are less cuts than previously expected, but it's not a hiking scenario, right? Because at the margin, again, you're still seeing that labor market weakening.
What happens though if the Fed doesn't cut it? Will the market be able to sustain some of this momentum?
I think so. I mean, you've seen, 8 cuts priced out over the course of last year, and the market was up 25%. Right? Like, it is able to sustain it. I think what's been so shocking to everyone is the fact that GDP growth, it doesn't seem like the U.S. economy is particularly interest rate sensitive, right? There are parts of it that are housing, but and some cyclical parts, but for the most part, it's really just been resilience.
Abby Yoder of JP Morgan Private Bank. Thanks so much for joining us in studio.
Thank you.
Good to see you. Everyone, coming up, Starbucks CEO Brian Niccol joins Morning Brief to talk his turnaround plan for the coffee giant, the menu changes you could see this year, and much more. That's coming up next.
Welcome back to Morning Brief. I'm Brian Sozzi, Yahoo Finance executive editor, along with our very own senior reporter, Brooke DePalma. Now, Starbucks topping estimates for its fiscal first quarter, but still, they saw same-store sales drop for the fourth straight quarter. This after the coffee giant kicked off a turnaround plan last quarter to help revive its U.S. business. Returning now for our next interview with him is Brian Niccol, Starbucks CEO. Brian, always great to get some time with you, coming to us from the Starbucks store. Let me start on this way, Brian. Got a note from one of my contacts this morning that said this: Starbucks is still a highly controversial stock, but at least things don't seem to be getting worse. Is that just the narrative investors should accept for right now?
Look, I think we're definitely in the middle of a turnaround. We said there were 4 things we were going to do, right? Reintroduce the Starbucks brand to the world, bring back the coffeehouse vibe, support our partners because we know every experience starts and ends with them. And then obviously we want to win the morning. And I think what I would say, Brian, is we're making progress on every one of those. And so I'm confident we stay after these strategies. We continue to make progress. We will get the results that Starbucks should earn. And, I think most importantly, our partners and our customers will be exactly where they want to be, which I think is going to be in our stores, having a cup of coffee, and you might have even heard me talk about this, have a little mug hug going on for us. So
that's dope. Mug hug. We'll take that offline, Brian. So let me on the earnings call, I did see green shoots. Now, can you sit here and say that if we're having this conversation 2 quarters from now, Starbucks US, that North America business, same-store sales are going back up again?
Look, the whole reason why we're executing against these strategies is for that outcome, Brian, right? And, the intention is we want to return to growth in a meaningful way, both the top line and the bottom line. But, we got to be smart about how we reinvest into the business, fix the elements so that we know we have consistent performance going forward. So by all means, the intention is to return to growth. And, I'm glad you picked up on some of the early wins that we're seeing, but we're not where we want to be yet. But I'm confident we stay after these strategies. We continue to test and learn. We listen to the feedback. We take action. We will return to growth.
Brian, I do want to hit on those plans to announce layoffs in the coming months. Restructuring charges are set to peak in Q2. How many jobs will be impacted?
Look, we're working through that, and you never love the idea of having to restructure because it impacts, people, and that's at the heart of our business. But in the end, what we know we have to do is we have to have a support center that is structured such that we can have accountability, clarity of work, so that we can support our stores and our partners in the Green Apron in the stores effectively and efficiently. So we're working through that over the next, 60 days, and obviously we'll share those details as they become available.
Another change you're making is cutting the menu by 30%. How are you assessing what doesn't make the cut here? Is it syrups? Is it sauces? Is it full-size drinks?
Yeah, look, it's a little bit of everything, is how I would describe it. And really what we focused on is what are the items that are not, frankly, selling a lot every day. And they get in the way of us selling the things that our customers really want and what our baristas really want to make. And so we have to clear the noise out, both in food and beverage. And then that opens the door then for, I think, better innovation that will hopefully resonate even more so for our customers, and then also give our baristas the ability to really demonstrate their craft, give them the time to connect with our customers, and really kind of do their thing. And so I've committed to getting rid of the noise, and that's what we're going to do.
Brian, it sounded, and you can tell me if I'm wrong here, it sounded like Starbucks walked back a prior cost-cutting target of $4 billion on the earnings call. Is that still the benchmark for investors in terms of how much cost you could take out of the business? Because I think that was a big number. Got a lot of people excited when it was announced that this is going to be a real tailwind to Starbucks' margins.
Yeah, look, I think there's definitely efficiencies to be found in our business. What that exact number is, we're working through it. The reality is we need to be focused on how we turn around the business, get growth going. At the same token, not lose sight of let's be smart about capturing the efficiencies to help offset any of the investments that we have to make. And then longer term, just make us a much more profitable, economically viable business going forward, right? Nobody likes to have cost that's unnecessary. And we're going to be laser focused on eliminating those unnecessary costs while we invest in the business to grow going forward.
You see the potential to double the U.S. market in the coming years. How do you do that without saturating the market?
Yeah, look, the good news is I've seen lots of markets where Starbucks is still underpenetrated. And, you know, there are great examples, whether it's like in a Texas or in the Southeast, where we just have tremendous opportunity to continue building the Starbucks business, both physically and then obviously in customers' hearts and minds. And so you're going to continue to see us build stores smartly. As we do that, we're also going to renovate all the necessary stores that we need to renovate. And then, you know, unfortunately, there will be some stores that we'll have to close along the way so that we set ourselves up for success going forward. But tremendous opportunity. The brand is beloved. And when we get things right, I think people are going to come back to, you know, the Starbucks experience that they've always wanted and continue to really desire.
One of your biggest growing competitors, Dutch Bros, has grown tremendously in the Texas market in recent years. Do you feel like Starbucks has fallen behind the competition there?
You know, look, I don't think we've fallen behind relative to anybody. What I do think is we've had some missteps in how we've gone to market, and we're fixing those, right? I outlined those 4 key strategies. What I do believe is when we are on our game, there's nobody like Starbucks. And so, you know, I really do believe the combination of our partners, the quality of our coffee, the craftsmanship that we provide, and then the third place experience that we can deliver, nobody else does it like us. And so we're going to get back to doing those things so that we can be, you know, what I believe is the Starbucks that we all want and the Starbucks that I think will be successful going forward.
Brian, I think I've been covering Starbucks 15 years in some various capacities. Now, I've always known it as an inclusive brand. Why shouldn't a Starbucks store be a place where someone down on their luck could get a glass of water?
You know, look, here's what I will tell you is our partners and our customers consistently gave me feedback that in order to be the coffee house that we want to be, we need to bring some practical pieces to our code of conduct. And that's what we've done. And I think what you'll see is our partners only want to provide a great experience, have people feel welcomed, feel like they belong in our stores. And so obviously our first priority is our paying customers. And, you know, I think that just makes a lot of sense. And when I talk to our customers and our partners, they agree. So I think we're just doing what is practical. And, you know, I believe in the end, if you come into a Starbucks store, you're going to feel welcomed. You're going to feel like this is a place I belong. This is a place I want to spend time. And our partners are going to take care of you. So that's the environment I want to create.
Brian, I can only speak to the stores that I visit in my various neighborhoods, and I'm sure you've been able to visit a lot of stores. But the stores that I've seen, I mean, some of these are dodging, not the physical stores, but the crowd around the stores. And, you know I've walked in a couple locations sometimes feeling unsafe. Do you have to put now security in these stores? How do you protect your baristas and your Starbucks employees in these locations?
Yeah, look, that's a number one priority of ours. And if we do need to have additional security, we'll do it. You know, full stop. The number one priority for us is our partner needs to be supported. They need to know that they're safe, and they need to know that we're going to be right there with them. So, you know, hopefully we've gotten the feedback, and when we get the feedback, my commitment is we take action so that we support the partner to have a safe environment so they can do their job with excellence and give our customers a great experience. So I've seen it, and we're gonna work with our partners to make sure that they're supported and protected without a doubt. And look, if it gets to the point where it doesn't make any sense, we'll close the store. This is about doing the right thing for the community of that store, and that's what we're committed to doing.
Certainly, we saw Astor Place close a few years ago. I know last time we spoke, you were looking into that. Any feedback that you heard? Is that the reason why Astor Place closed here in New York City?
I don't know that specific store or that specific issue. What I can tell you is these are the principles that we're using to support our partners.
Brian, really quickly, mobile order next on your to-do list. How will that look different in the next 6 months? And about quickly.
Yeah, look, I think we're going to bring, it's kind of a funny comment, but we're going to bring order to mobile order. Right now, it's just a first in, first out business, and we have to put some sequencing into that business. And right now, we're not marrying up when people want their drinks, because I see the drinks sitting on the counter, and then when I talk to our partners, we end up having to remake drinks because they've been sitting there too long. So we have some opportunity to better sequence the mobile order. When we do that, and I've seen this already starting to happen in a handful of stores where we're doing a pilot, it's a better experience for the customer because their drink matches when they're showing up. It's a better experience for our in-store customer because it's no longer competing with that mobile order. And then it's a better experience for our partners because they understand who they're serving when. And so that is really what we're after. We want to bring order to mobile order and then set people up for success, whether it's an in-store experience or a mobile order experience.
Brian,
and a drive-through.
Brian, if you can somehow get my Chipotle account linked up with my Starbucks account, I can order a coffee and a burrito in one tap. You know the people there. You got those connections.
I might know some good people at Chipotle that might be able to help you out, Brian.
I appreciate you, Brian.
But look, I'll tell you what, one of my best days is having some Starbucks in the morning and maybe a Chipotle burrito for dinner. So
that sounds like a good day.
Stuff.
Is always on top of his
It is a
game.
good day.
Starbucks CEO, Brian Niccol. I almost called you Chipotle CEO, but I know that's your former job. Brian Niccol, always good to see you. Talk to you soon.
Yeah, great seeing you guys. Take care.
Thanks. All right, guys, back to you.
All right, thanks so much, guys. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, Apple has been working with T-Mobile and Elon Musk's SpaceX to add support of Starlink networks on iPhones. The iPhone's recent update, iOS 18.3, supports Starlink. Musk posting on X that images, music, and podcasts should work with the current Starlink technology, and in the future, we'll see video.
Plus, representatives for HPE reportedly meeting with President Trump's antitrust team over its $14 billion bid to buy Juniper Networks. This is according to reports from Bloomberg. And people familiar with the matter saying that the DOJ is ready to challenge the deal should it close. Yahoo Finance spoke with HPE CEO Antonio Neri at Davos last week, and here's what he had to say about the deal.
We are working with now the new administration, and we feel confident that we will get this deal through.
And T-Mobile beating on the top and bottom line in the fourth quarter, helped by strong growth in monthly phone customers. The company adding over 900,000 postpaid phone net customers, significantly more than estimated. T-Mobile also posting strong full-year guidance that beat Wall Street's expectations.
Keep it right here. That does it for Morning Brief, but Catalyst is up next. Welcome to Catalyst. I'm Shauna Smith. We're 30 minutes into the U.S. trading day. Let's get the three catalysts that we're watching this hour. First up, we bring you the Fed Day Decision Guide and what to watch for in Chair Powell's news conference. Plus, we push ahead to big tech results and how investors might react to AI announcements. And a deep dive into DeepSeek. Is the technology as advanced as they say? And what are some of the concerns surrounding its emergence? We'll discuss that and much more coming up in the next hour. Let's take a look at some of the market headlines here to start the hour and where things stand. Just about 30 minutes into the trading day, we are coming off a bit, or losing a bit of that momentum that we had seen in terms of the rebound that we saw yesterday. The Dow, though, back in positive territory, up just about 42. You've got the S&P just below the flat line. The Nasdaq really losing considerable amount of steam, falling below the flat line, now off just about 0.5%. Of course, the move lower here, especially in the tech-heavy Nasdaq, coming ahead of a number of critical tech earnings results that we're going to be getting here over the next 24 hours to 48 hours here when you take a look at who is reporting tonight and who is reporting with Apple also after the bell tomorrow. Let's flip over to the bond market. Lots of focus on yields and the levels that we're seeing. You've got the 10-year still above that 4.5 level at 452, so well off the highs that we've seen. Another move to the downside here off just about 3 basis points. And finally, taking a look at some of those tech names that have earnings after the close. We will hear from Microsoft, Meta, Tesla, IBM, all set to report here this afternoon. You're seeing 3 out of the 4 actually trading to the downside. Tesla continuing some of that selling pressure that we've seen this week, off just about 1%. The same goes for Microsoft, Meta off about 0.7%. Well, we will get to hear from the CEOs of Microsoft, Meta, Tesla, and IBM for the first time since we saw markets spooked by Chinese AI startup DeepSeek earlier this week. Our very own Dan Howley is here with us. And Dan, the big focus is going to be on AI spending plans, how big of a threat DeepSeek could potentially be here in terms of the AI story. What do you think we'll hear?
Yeah, I mean, I think there's going to be probably a lot of praise for what DeepSeek has done. We've seen that so far from some tech companies saying that this is, a breakthrough, kind of saying that this is amazing, yada, yada, yada. But I think what investors want to know is, okay, does this impact what you, company, X, Y, Meta, Microsoft, are doing? And does this mean that you're going to pull back on spending? Now, I'm going through, obviously, a number of analyst notes, and one of the big things that's been pointed out is that DeepSeek had announced its V3, the platform that was developed with $5 million in December. R1, the one that's kind of blew up and is the reason why everybody downloaded the app, debuted on January 20th. And so if you look at those dates, then look at more recent announcements from big tech companies. Meta announced that they're going to spend upwards of $65 billion in 2025. Different analysts are saying that, look, there's no way that these companies don't know the techniques that DeepSeek used, and that they probably did, and figure we still have to do these investments regardless. And so a number of analysts I've been kind of reading up on have said they still need to spend money. These companies still need to build out. So the build out is still something that they're going to have to do. And even if the efficiency gains are there, then that means that more people will end up using AI capabilities. And as a result, they'll still need that huge amount of computing power to keep up with that kind of demand. So I think that's something that we're going to want to kind of find out more about from Meta, whether that holds water, as well as Microsoft. Their biggest contribution to the AI race is their work with OpenAI. And DeepSeek basically called out OpenAI saying, look, we managed to do this at far cheaper prices. There's a lot of nuance here, whether or not the pricing includes the complete development of these AI platforms. They specifically point out, DeepSeek, that is, that they don't account for certain parts of training or certain parts of development of their AI models in that $5 million number. So there's still a lot up in the air, and I think that that's the kind of dust is starting to settle a bit. People are kind of regaining their minds after losing them so badly on Monday. And I think that we're going to start to see kind of more explanation as to the nuances of this whole conversation when it comes to DeepSeek and the big tech companies that it really kind of is going toe-to-toe with.
I would also think the Trump administration, the policies maybe that we could see coming from the White House will likely be a topic of conversation maybe on some of these earnings calls, just given the presence that we saw at inauguration. Yeah,
I mean, look, going into the weekend, that was my big takeaway, was going to be, well, big tech is going to be looking at what Trump is doing, and that's really going to be the main conversation. How are you going to deal with tariffs? How are you going to deal with potential issues when it comes to China? What are you going to do if there's any kind of changes to how AI is regulated? We saw the executive order that Trump had rescinded from the Biden administration, and what impact that could have on your ability to develop new models. Now it really is just what's going on with DeepSeek, and I think once they get through that There's probably going to be a preamble about it in some calls. Once they get through that, they're going to have to answer those other questions as well. They're still just as important as they were last week, though may not be as spicy as the kind of questions that analysts would want to ask about DeepSeek. So there's a number of things going on here, not to mention, by the way, are you making money on all of these investments? And I think, that's obviously something that Meta has managed to convince their investors of. Microsoft, though, kind of not exactly what investors wanted in the prior quarter, despite a good showing from their cloud unit, which includes AI. So, we're going to have to see what investors take away from Microsoft's report when they announce, and whether or not they're satisfied with that investment and the resulting revenue that it's generating.
All right, we will see. Only a couple of hours from now, right, Dan? You got a jam-packed day ahead of you.
Yeah, it's busy.
To say the least. All right, Hallie, thanks so much. Well, big tech earnings and the Fed decision are the two big market drivers today. Let's talk about that and more. We want to bring in Stuart Kaiser. He's the head of U.S. equity trading strategy at Citi. And Stuart, we were debating where to start here, but let's start with big tech. Obviously very critical here to the market. In terms of what we're hearing tonight and what we hear over the next several trading days as we do get more and more results, how critical is that to the market narrative?
I mean, I think it's very important. It was going to be very important to begin with, and then obviously the DeepSeek news on Monday makes it even more important. I actually think, frankly, the results will matter. Both the most of the hyperscalers kind of already recently updated their guidance on CapEx spend. So a lot of this may be actually what gets said in the press conference and what is the CEO's kind of body language. How committed are they to that CapEx spend? How vital do they think that spending, and particularly the really, really high-end NVIDIA chips, are to their development? So numbers matter for sure, but I actually think incrementally speaking, the commentary from the CEOs is going to be probably more important than it otherwise would have been.
Does the decline that we saw earlier this week and some of that selling action, does that at all change your longer-term view? I know you were very positive of large cap growth going into this year.
Yeah, we're still generally positive on it, but I think you have to be in a little bit of wait and see mode just in terms of how this is ultimately going to play itself out. So yeah, we're still positive on the space, but we're not exactly aggressive buyers here. And a lot of that has to do with positioning. People are so long these stocks to begin with, and if the news over the weekend does force a little bit of a positioning rebalance, then that's going to create kind of some churn and some volatility. So we've been a little bit cautious in terms of stepping back in, but kind of, big picture, we do still like that part of the market.
What would those levels be in order for you to be more of a buyer?
Honestly, it has less to do with the price level than I think the clarity around the news. Already you've seen, Elon Musk kind of push back a little bit. Some NVIDIA's kind of pushed back a little bit on the DeepSeek update. So honestly, there's just not a lot of clarity exactly on the cost, as Dan mentioned, on the efficacy. I know those models have actually performed pretty well in some of the testing, but we just don't know at this point. And that's why I do think kind of the body language from these CEOs in terms of what is their view on the medium term, has that shifted meaningfully, is going to be very, very important.
So the resilience that we've seen in most other parts of the markets this week, how reassuring is that to you?
It's quite reassuring. I think that you have seen a broadening out. I mean, big picture, if you said, look, AI just got cheaper and faster to develop, that's good for the economy. It's good for most stocks in the market. It's obviously very negative for a pretty small cohort of stocks that have been under a little bit of pressure. I think the most worrying thing, frankly, yesterday was the fact that utilities didn't recover as much, because utilities kind of that knock-on AI infrastructure story, and we didn't see, incremental buying in that space. So I think that's, a little bit incrementally concerning. But otherwise, look, the fact that on Monday, 2/3 of S&P stocks were up, more than half of Nasdaq stocks were up. S&P equal weight was actually up on the day. A number of sectors, utilities not being one of them, but, healthcare staples, these performed well. So all that I think was very encouraging. It wasn't just a sell everything moment. It was, this is a risk to positioning and sentiment in a key part of the market without a doubt, but it did kind of get localized in there.
If we do see maybe more sideways action or even potentially more selling within utilities, what does that signal to you?
Look, I think it does suggest that these AI adjacency sort of stories, and clearly that is a big part of the CapEx spend story, is under pressure. You might argue if you get more widely distributed AI, you're still going to need all of that power generation. But to the extent that we don't see recovery in that part, I think one of two things is happening. Either that AI CapEx spend story is kind of running out of steam a little bit, or secondarily, you just have a real big positioning issue that needs to be dealt with in that space. Power generation to us is a theme, kind of medium term, that just makes makes a ton of sense to invest in. But again, when you have these positioning moments, from our perspective, you just kind of step back until you have a little more information.
Stuart, how big of a deal, or maybe how major of an event, maybe it's not as big of a deal, is the Fed meeting this afternoon? And I guess the real risk, much of this is going to be around the rhetoric surrounding Powell and how dovish versus how hawkish maybe some of that sentiment's going to be.
Yeah, I think you hit it right. It's really on the rhetoric. I mean, they updated their economic projections in December. All of the data we've gotten this month, whether that's unemployment rate, inflation, et cetera, have been right in line with their expectation. The market's pricing 2 cuts, which is exactly what they forecast. So from a data perspective, there's really not a lot for them to say. So it's going to be, how are they reacting to the news from DeepSeek? How are they reacting to potential policy news and tariffs and things of that nature? You could also argue that the tariff news has been better than feared. Mm-hmm. So from their perspective, that actually removes a key point of pressure. If you had large across-the-board tariffs initiated over the last week or two, the Fed would have had to have really dealt with that directly. In this case, they can sort of say, hey, we'll wait and see.
What about the threat, though, of what could be imposed on Saturday, February 1st?
Yeah, it matters, but I think the worst case scenario was that Trump came out full bore, across the board tariffs, very aggressive on China, et cetera. And we haven't had that. Bessent's actually sort of nodded that we might get this very gradual build in. And from a Fed perspective, that's much easier for them to deal with from a policy perspective. They've been very clear, and our economists agree, they are not going to adjust their policy stance based on what could happen. Until we see the tariffs announced and implemented, they're going to kind of be in wait and see mode. And I do think the first 2 weeks of the Trump presidency has actually given them a little space to continue to do that.
If we could pull up the graphic that we just had a moment ago, and it very much, I pulled it from your note, and you talked about the implied volatility or some of the market moving events that we could see here. We narrowed it down to over the next week, or over the next month, excuse me. When we already talked about the Fed, we talked about big tech earnings, obviously, that's front and center. But what about payrolls next Friday? How big of an implied move could we potentially see as a result of that number?
Look, we think the unemployment rate is probably the single most important macro data point you're going to get every month. So the day at the beginning of January was very favorable, got that unemployment rate back below 4.1%, which was a big surprise. So next week is going to matter. I mean, if you see a significant uptick in the unemployment rate, I think that potentially puts the Fed under pressure and puts the market under pressure as well. So that's what we'll be watching. You have a lot of seasonal adjustment stuff going on this time of year. So that number has like a lot of wiggle room around it. And for that reason, I think you will see options markets pricing in a pretty good risk around that event.
What is your assessment surrounding that? Just in terms of the fact that the labor market has remained very resilient, just I guess that downside factor risk, how real is that?
Again, I think if you got, our economists believe the unemployment rate is going to move back up towards the 4.5% range by the middle of the year. That type of move, in our view, will be quite negative for equity markets. So, so far, the data has been better than expected. I think the Fed, the last 12 months, has gotten data that couldn't have been better from their perspective, right? Labor market holding in, inflation coming down. I think inflation's kind of been pushed a little bit off to the side, and the focus is right now on the labor market. And to the extent, the Fed has the unemployment rate staying below 4.3%. If that happens, that is unequivocally good for equity markets. Mm-hmm. But if you do get this inflection point, it could be a challenge. A lot of folks are saying, well, we want more rate cuts, and we're sort of in the careful what you wish for category, because the data that would motivate those rate cuts would, in our view, be a weaker labor market. And I think if you're an equity investor, that should not be what you're hoping for.
All right, Stuart, always great to get your insight. Thanks so much for taking the time. Well, President Trump, past performance is certainly no guarantee maybe of future results. Our very own markets editor, Jared Blickery, taking a look at equities performance before and after Trump's inauguration, sharing his findings with us now. Jared.
Thank you, Shauna. We've only had 6 full trading days since President Trump's inauguration, but markets are already showing a different color under the new president than the 73 days between the election and last week's inauguration. The blistering rally in crypto and Nasdaq stocks, which were up over 6%, as we can see here, is morphing into a more cyclical-driven rally that's favoring the Dow, which was up 3% after the election, and then another 3% since last Monday. Meanwhile, the Nasdaq is down about 1.5%. And before we get into the sector winners and losers, which are pretty surprising, we should take a look at what happened under Trump 1.0 in 2016 and 2017. Much like the current backdrop, under Trump 1, the dollar and treasury yields soared in anticipation of the Trump trade. But unlike the current setup, Bitcoin and gold didn't fare so well into the inauguration in 2017. However, afterwards they soared as the dollar and rates reversed to the downside. Fast forward to today, and as Trump spoke last Monday, U.S. rates and the dollar, they tanked, and the dollar actually had its biggest drop in over a year. In a matter of hours, one of the biggest investor concerns and risks, that strong dollar wrecking ball, it seemed to fade in investors' minds. And this set the stage for a massive reversal in large cap tech, which we can see here among the S&P 500 sectors, where we're showing gains and losses in market capitalization. So tech stocks, they gained over $500 billion in value from election to inauguration, but have given back more than that, $600 billion. And in terms of winners and losers, we have several sectors which have posted impressive gains both before and after the inauguration. Consumer discretionary, that's home to Amazon and Tesla, they tacked on $850 billion, then another $60 billion in the two periods. It's impressive, as Tesla has actually been a huge drag since the inauguration, and we're going to get to that in a minute. Meanwhile, financials and communication services, home to Meta and Alphabet, they've also performed well in both periods. But we do have some reversals. In addition to tech, energy was up 3% prior to the inauguration and is now down over 3%. Utilities, which are now an AI infrastructure trade, in some cases, they were up slightly and are now trading down. Then we have consumer staples, materials, and real estate. They were all down, but are now trading to the upside. The biggest surprise, though, it might be healthcare, which shed over $300 billion in value after the election, and since inauguration, it's up over $250 billion. So if there's any theme here, the AI trade is giving way to a mix of cyclical and defensive names. And we see these dynamics playing out in America's biggest stocks, starting with Tesla. After the election, Elon Musk's flagship company tacked on an impressive $560 billion. Since inauguration, it's shed about $100 billion of that. And we've seen a similar pattern of big gains followed by a give back in other mega caps like Alphabet, Broadcom, and Apple to a smaller degree. And we have to talk NVIDIA, the giant outlier here, which shed nearly $600 billion in one day after the inauguration. It's clawed back some of that, but it's the only mega cap that was down both before and after the inauguration. I think the broad takeaway is that the so-called Trump trade, it's a moving target. And the dynamics that we saw after the election have faded somewhat, very similar to what we saw under Trump 1. And for that matter, it's something we've seen with many pivotal elections. If history is any guide, then tech will find its footing again, so will Tesla and Bitcoin, and the Dow will not lead forever. It's an unavoidable fact that the emerging trends that we're seeing right now will eventually reverse as well. But right now, we have the beginning of a roadmap for the first 100 days where the strong dollar might not quite be the immediate risk that investors had feared. Back to you, Shauna.
All right, Jared, certainly a lot for us to think about. Thanks so much for breaking all of that down. Coming up, we're taking a look at some of today's top trending tickers, including a preview of Tesla's results that will be out after the bell this afternoon. We've got that for you when we come back. Now it's time for some of today's trending tickers. I'm joined by Yahoo Finance's very own Josh Schaefer. You're going to be seeing a lot of him over the next 2 days here. So we're going to give it a test run here today. Let's get in the QR code below to track the best and worst performing stocks of this session with Yahoo Finance's trending tickers page. Just added some pressure here.
There we go.
All right.
We got to do well here, Sean.
All right, let's talk about Apple. First up, Apple downgraded to perform from outperform at Oppenheimer. Analysts citing 2 challenges for iPhone growth, including stronger competition in China, also a lack of compelling AI apps. Now, this follows downgrades from Jefferies, MoffettNathanson, Loop Capital, and DBS Bank earlier this month. Apple is set to report its fiscal first quarter results tomorrow after the market close. So obviously this adding a little bit of pressure here to Apple stock. Like I just said, this is the 5th downgrade that we've seen on Apple in the last month. And I know you've really been looking at the pricing action, the outperformance that we've seen over the last 2 trading days versus some of the losses that we saw prior.
Yeah, so if you go back about a week ago, I had started to look at Apple stock. I think it was down 13% over the last month. So going into the middle of December, kind of in the broad market drawdown. And it felt like no one was talking about it. Yeah. There was a world where Apple stock down 3%. And it's the headline leading the newspaper the next morning, right? Or leading our website. And that is not quite the world that we live in anymore. Perhaps that's more NVIDIA. But what was interesting to me, Sean, is post DeepSeek, right? So DeepSeek sends NVIDIA stock down, but it didn't send all of the Mag 7 stocks down, this new cheaper AI solution. And Apple actually caught a bid. Apple up about 7% over the first 2 days in the DeepSeek action. Perhaps some of that read being, well, Apple was slow to AI, right? They didn't invest a lot in AI. Well, maybe they didn't need to invest a lot in AI and they'd actually potentially be a beneficiary of cheaper AI solutions. I think that will be an interesting thing to listen for on the earnings call because the headwinds that Oppenheimer lays out here are well known at this point, right? Stronger competition in China. iPhone sales aren't going as well as people thought. These are not new things that we haven't already been talking about for the past 2 months.
Right, and that was exactly to my point. And almost my question that I was having after reading this was just how much of these risks are already priced in, given the fact that this is the 5th downgrade that we've seen in the last month, given the fact that a lot of the concern surrounding Apple, it's no secret that they have been late to AI in terms of some of their investments. It is no secret that obviously some of their sales within China, not only pressured by access here to some of those AI apps, but also just the domestic pressure and competition that they're seeing within China, and obviously losing a bit of market share. That's clearly a concern here to so many of these analysts without a clear runway or really turnaround plan that seems highly likely at this point.
Yeah, and I think we all keep talking about the same thing because most of us are iPhone users, right? You know, with that new Apple update, there's just not a ton of AI solutions there that I as a consumer really enjoy or think I need to buy a new iPhone to make sure I have this technology, or I'm telling my friends, call, and what they can sort of maybe a story they can tell for investors here is what are the things coming down the pipeline in terms of AI solutions on our Apple products that is actually going to make people upgrade. Right now, it seems like clearly Wall Street analysts think they're lacking it, and I think even just the general consumer thinks they're lacking a compelling AI pitch to make us all upgrade our phones.
Yeah, certainly. And Oppenheimer is still making the argument that even despite some of the selling that we had seen, valuations still very high, at least relative to historically speaking, in the 10-year average. And they're saying maybe there's not enough to justify that at this point. All right, well, next up, we've got Trump Media expanding it into financial services. Now, this is an investment of up to $250 million with Charles Schwab. The financial services division will be known as TruthFi. The company expecting to launch products and services, including investment vehicles, this year. I gotta admit, I did a double take when I saw this headline. I was a bit surprised. Maybe I shouldn't have been, just given what we have seen in some of the competitors out there, maybe a way to differentiate the business model and the offering here. But again, a team up here with Charles Schwab was a bit surprising to me. When you take a look at the market's reaction, Charles Schwab actually moving to the upside on the heels of this news.
It just adds to what does this company do, right? So we have Truth Social. Okay, I can understand that, right? That's a social media company. We have Truth Plus, the streaming platform, kind of in the same space. Now we're going to do financial services. And how does this all sort of mesh together for a company that we know doesn't make a lot of money and there's really no earnings here? It kind of just trades on random news announcements or perhaps what the president says. And I think that's certainly the action you're seeing today. Any news on DJT that looks relatively positive, you usually get this kind of pop in the stock. But I don't think it's really clear exactly what they're trying to do with TruthFi. The crypto angle here was interesting to me, given all of the recent meme coin discussions about the president and his family members. So they're going to take $250 million and potentially put it in some crypto assets. They said Bitcoin and other assets. I sort of wondered what are the other assets beyond Bitcoin that some of this money might be allocated to. There's a lot of crypto coins out there, and some of them perhaps relate to Trump media in certain ways.
Yeah, and they talk about customized ETFs as part of this strategy as well. The CEO put out a statement. What caught my attention was he said that developing American first investment vehicles is just another step forward of our goal of creating a robust ecosystem through which Americans can protect themselves from the ever-present threat of cancellation, censorship, debanking, and privacy violations committed by big tech and woke corporations. So again, it very much tied to some of that rhetoric and what we've heard from the CEO in the past. But you got to ask what some of the appetite is.
I think I wondered if this stock would maybe go away post-election because there's so many other ways to play Trump's presidency in the market in perhaps more fundamental ways. I think this shows us that this is probably here for the next 4 years. Even if we don't understand what the company does, we're going to be talking about the ticker DJT.
Wishful thinking, or depending on how you look at it by you here. Because certainly I don't think it's going anywhere anytime soon. All right, Josh, great stuff. Thanks. Let's take a look at Tesla. Tesla is set to report fourth quarter and full year 2024 earnings after the bell today. It will be the company's first report since the inauguration of President Trump and since CEO Elon Musk took on a new role as head of the Department of Government Efficiency. Here with more on what to expect, we want to bring in Garrett Nelson. He's CFRA's analyst. Garrett, it's great to have you. So certainly we saw Tesla shares shoot up about 60% since the election. We've seen a bit of a return over the last couple of weeks. We've seen a bit of a cooling there in Tesla stock. What is this signal heading into tonight's results?
Sure. So let's break down the releases. First, how the quarter is going to turn out, and then any potential guidance that they might provide. We actually feel pretty good heading into the quarter. If you look at Tesla's quarterly production and deliveries report that they put out a few weeks ago, there were some positives in that report, specifically a record high in terms of vehicle sales and energy storage deployments during the quarter. That's important because the energy storage segment has significantly higher margins than the auto business. And deployments were up about 240% year over year during the quarter, 11 gigawatt hours. So also, if you look at the breakdown, they had a much higher percentage of leased vehicles that they sold during the quarter as opposed to just vehicle sales. And leased vehicles also have much higher margins. So, those things have positive implications for their earnings for the quarter. So you look at the consensus, it's 77 cents. They did 72 cents last quarter. We see no reason to believe that they can't top that 77-cent number. But more importantly will be the guidance. And this is where we're a little more uncertain because Elon Musk last quarter guided for 20 to 30% increase in vehicle sales this year. And we think it could be a stretch for them to hit that. We're currently estimating that their vehicle sales increase only about half that growth rate, so about 10 to 15% for the year.
Do you think the market's going to be able, and you as an analyst, continue to look beyond that?
Well, that's the really, that's the key. Obviously, there's been significant multiple expansion in the stock. You mentioned the run-up since the election, which we think is justified, just given what the Department of Transportation is targeting in terms of regulatory easing, in terms of autonomous driving. And Tesla is really an autonomous driving story going forward. You look at the global market opportunity, we think it's about a $5 trillion opportunity. And, Tesla is leading the market in terms of U.S. auto manufacturers in terms of their autonomous driving software. So we do think it is justified, and we think you're going to see a much easier regulatory pathway to fully autonomous vehicles going forward.
Garrett, I'm curious from an analyst perspective, just Musk's role within the White House right now. Is that worrisome to you? We talked a lot in the past about how much time, just given his various ventures, he's spending at Tesla versus maybe what investors would like to see. This adds another layer of complexity, I think, to that argument. Are you at all concerned?
We are. I mean, it is certainly, another title that he's adding to his very long list of responsibilities. So, it does add a degree of uncertainty to the story going forward. But I think what became clear following the robo-taxi day in October is that Tesla is a autonomous driving story going forward. And so that's why we viewed it as a big positive, Trump's victory, and the fact that he's going to have a place at the table in terms of the regulatory framework going forward for autonomous driving. And really what Trump's win did is move the story forward. Before we were looking at a potentially very lengthy state-by-state approval process. Now you're looking at a single superseding federal regulatory process for companies to achieve and get permitting for full self-driving.
So I guess to what extent then does that fundamentally change maybe the argument or expectations surrounding AI, surrounding robotaxi, and how much more realistic or quickly we could see that then being adopted?
I mean, before we were kind of looking at this as sort of an end of the decade event. Now, that combined with the very tangible improvements that they've made in their full self-driving software since incorporating NVIDIA's chips and GPUs into their process, we think it's something you could see in the next 2 to 3 years. So, it was really a game changer, and I think the market really recognized that, and that explains the run-up in the stock since the election.
All right, Garrett, always great to get your insight. Thanks so much for taking the time to join us here ahead of the results tonight.
Thank you.
Keep right here on Yahoo Finance. Much more coming up on Catalysts. The Trump administration saying it will offer buyouts to millions of federal workers who choose to leave their jobs by next week if they don't want to return to the office. It'll be done through a government-wide deferred resignation program. Now, workers must agree to resign before February 6th, and they will get paid through September. All full-time federal employees are eligible, except for members of the military, employees of the U.S. Postal Service, and positions related to immigration enforcement and national security. Now, this comes after President Trump issued an order on his first day in office directing all executive branch agencies to end remote work rules.
You'll let me finish.
You're taking a look at a live shot right now of RFK Jr.'s first Senate confirmation hearing to lead the Department of Health and Human Services. It's currently underway right now on Capitol Hill. Clearly implications here for the healthcare sector if he were to be confirmed or not confirmed. Yahoo Finance's Anjali Kamlani joining us now with the latest. Anj.
That's right, you guys. As you can see, it's already starting to get a little bit heated right at the start. Senator Wyden getting into the anti-vaccine stance and issues that Robert F. Kennedy Jr. has, statements that he's made in the past about vaccines, creating some sort of eruption in the audience, and order had to be called at this hearing. But so far what we know is that within this Senate Finance Committee, the focus is going to be on not just the vaccines, but also some of RFK Jr.'s potential conflicts in the past, areas where he's making money with book deals, as well as other investments in pharma companies. But in addition, one area that seems to be the focus for both sides of the aisle is food, his stance on food. And that's where the testimony started earlier this morning on how he plans on addressing, as the potential head of the Health and Human Services Department, the issue with chronic diseases and the ties to food. He did say in a quote earlier that he does not plan on taking away all the bad foods, referring to McDonald's and Twinkies, as you can have them, but just know what's in them and the potential impact of the health on your family. We know, of course, that the biggest issue for investors is taking a look at what he says on vaccines. So far, he's taken a pretty balanced approach to that, commenting on the fact that while he has in the past said that not all vaccines are safe and effective, he then clarified in the testimony today that he meant for all people. And that's something that we'll need to parse through and watch closely. You can see the impact on the stocks right now, and not too much movement on these vaccine stocks as we continue to wait and see what the results are. Of course, this is a two-day affair. He is also set to speak in front of the Senate Health, Education and Labor Committee tomorrow at around the same time. So it'll be a combined effect to hear what his comments are and where he lands. Another big issue, of course, is reproductive rights. We have yet to hear any comments on that.
Yeah, and certainly it is a very heated hearing, it looks like so far. We've heard a lot of back and forth between senators and RFK Jr. up until this point. I'm curious, just from the reporting that you've done and the strategist analysts that you've talked to, just how much volatility or uncertainty surrounding health policy this really introduces into this sector, and just the ability then for some of these larger pharma giants and even small ones to navigate some of these issues.
It's more uncertainty than volatility right now. Everyone wants to wait and see what actually happens. If he does, in fact, sort of lay low on the vaccines and other issues, and then focuses more on the food policy, that's a shift. Meanwhile, he's also talked about being open behind closed doors. He's talked about being open to drug pricing and the issue of forcing patents for the most expensive drugs to be allowed to be copied by other pharmaceutical companies. So that's an issue that we haven't heard anything about yet, and could be an interesting one to really impact the sector. That's another area, again, of really stark uncertainty. We've seen some analysts talk about who could potentially be supporting him. There are some surprising voices that could be supportive of him, and this is largely coalescing around that food issue. So that's why it's interesting to watch the issue unfold and see how the various controversial statements he's made in the past are balanced out with the focus on food, which seems to be the one area that everyone seems to be able to agree on.
All right, we'll continue to watch the developments here. Anjali, great stuff. Thanks. Keep it right here on Yahoo Finance. Much more of your market action ahead. DeepSeek, the Chinese AI model that upended tech stocks on Monday, may not be as powerful as it initially seemed. Now, OpenAI is reportedly investigating whether the Chinese AI startup used OpenAI models to train its own and has evidence, they say, that Chinese entities have tried to pull OpenAI data in the past. The suspicions, if true, could mean that DeepSeek's model is much less impressive than maybe initially believed to be. Joining us now with what all of this means here for the AI backdrop, I want to bring in Olaf Groth. He is a CEO of Cambrian AI. It's an artificial intelligence advisory institute. Olaf, it's great to have you back here on Yahoo Finance. I'm curious just your assessment of the developments that we've gotten on DeepSeek here over the last several days and how the tech community, how your community, the AI community, is viewing this.
Yeah, it's good to be with you, Shauna. This, in my humble opinion, is still a fairly significant feat. Yes, there is the issue of using OpenAI's data. However, it is very commonplace, quite frankly, for a lot of these models to be scraping wild and crazy across the internet. And so I still think this is a fairly substantial engineering feat that experts have examined, and they found that these Chinese, very young Chinese engineers have done a great job at optimizing and working around constraints in a way that that oftentimes we in the West don't, and we throw additional money at it and make these models very expensive. So from an engineering angle, still, I think, a fairly significant feat. From the angle of what it will do for the ecosystem, look, this is a boost for open source. I think it's a proof case that open source, where you build on open source, open weight models with new innovation, is a promising path forward, and it will hopefully verticalize a lot of AI applications that are more affordable and therefore stimulating demand. And so hopefully this will be good for the market overall. From a geopolitical and national security angle, we'll have to see about this. I think the last word hasn't been spoken. For one, I think the data that you're generating by interfacing with DeepSeek does go to Chinese servers. That will become an issue, as it is right now with TikTok. And secondly, censorship if you use the cloud-based solution. And then, of course, the question is, how will we react from a policy angle to this new and fresh Chinese challenge? As it is, Alibaba and others are building on DeepSeek in turn. So this is, I think, the first step in a fairly severe acceleration.
Oh, talk to me a little bit more about that when it comes to the security concerns, the cloud-based use of it versus the localized use of it. It's confusing for a lot that aren't too familiar with the ins and outs here of the industry. So when you introduce that open source model, how does that then change or influence that conversation?
Yeah, look, I mean, open source just means that DeepSeek was built on Meta's Llama and some PyTorch frameworks. And according to latest posts from Mark Benioff, also used some research done at Salesforce. And so it used a lot of things that were in existence that's perfectly legitimate. In fact, that is the purpose of open source and the power of open source, because people can, in a very free and diffused manner, iterate on innovation that others have created, keeping everything transparent, open, and accessible and low cost for other people. Now, what that does mean is that open source models that generate a lot of data in the United States, then spreading that much more effectively, that data going to Chinese servers will become an issue at even greater scale. Because whether you're going through the API or you're cloud-based, the data goes to Chinese servers, and that may need to be negotiated if the app were to continue to live and thrive in the United States.
Olaf, then is it safe to say that the market then, to some extent, did overreact just in terms of what this ultimately means here for some of the U.S. players?
Well, I think it was a wake-up call, and as such, the market signal is right on the mark. But yeah, I think it was outsized, and it is a bit too conservative, because we have to keep the long view. In the medium to long term, I think open source successes around the world that are built on U.S. technology were foreseeable, quite frankly. Meta's model is very popular out there. It's very successful. And so that I think is an overreaction given the long-term promise, because as you make these models cheaper, more pervasive and more diffuse, then more people experiment, get proficient, and have an easier time getting to a return on investment because the cost is lower. That that will make, I think, AI solutions a lot more attractive to a lot of people, including for higher value and higher cost solutions with higher cost chipsets, such as NVIDIA. So I think longer term, this is good news for the AI economy.
Olaf, you mentioned TikTok briefly earlier. I just want to get your thoughts just on the fact that it seems like Trump seems to be pushing this bidding war here for TikTok. We got the entrance, potentially interest here from Microsoft. He's floated Elon Musk names in the past, just to name a few, that could potentially be interested in TikTok. How do you expect the administration to use this as a bargaining chip? And I guess, how do you see this evolving here over the next couple of weeks?
Yeah, look, I think Trump is using this bidding war, and I think he is instigating it and fueling it. There's some, I don't know, 10, 12 parties interested and active now in this in order to do a couple of different things. Number one, he wants to extract the greatest value for whatever the stake is that we are going to be acquiring, we meaning any entity based in the United States. So maximize the value, repatriate some of the revenue that Americans are making, as it were, into the U.S. economy, and make sure that it is based here with a U.S.-hosted solution, and then use this as a negotiation chit in the now, in the starting negotiations around trade, investment, that will also have to take into account cyber and data concerns. So this is the kickoff of that.
All right, Olaf, always great to get your insight. Thanks so much for taking the time to join us here.
Always good to be with you. Thank you.
Banks loaning, or who did loan Elon Musk $13 billion to buy Twitter, now X, are looking to offload portions of that debt this week. David Hollerith is tracking this and joins us now with the latest. David.
Hey, Shauna. Without being in the room for the conversations that bankers are having with potential investors this week over the X loans, we really can't say what yesterday's announcement really means in terms of the level of interest and what amount of money banks might earn on selling off these loans. But and the initial thought is it really can't hurt. And, banks are kind of looking for anything they can to finally get these loans off their books. Initially, the banks, Elon Musk, came out as sort of buying Twitter, which he named X, for $44 billion. And since then, the loans have lost their value, and they've sat on the books of these banks' balance sheets for a number of years. And by recording of that time, it's longest since 2008. And so this drags down their capital a lot. So they're looking for anything they can do to sweeten the deal and finally get these loans off their books. They're risky, and it requires a lot of capital they have to keep on hand. The Wall Street Journal reported, though, that it looks like things do already look a lot better than they could have been. Bankers are offering the loans for about 90 to 95 cents on the dollar. It seems like compared to where things were, that's actually a pretty lucky outcome for the banks. There's also, as reported by Bloomberg, there's been a sweetener, which is there's a stake connected to these loans, which is a stake in Elon Musk's artificial intelligence company, XAI. So there's a lot of potential here if you also add in the interest payments for the banks to even get to break even when selling these loans. But again, the fact that they've had to hold on to them for so long has been pretty rough. It's even led to an argument for why certain banks that were a part of this syndicate, such as Bank of America and Morgan Stanley, have underperformed in the leverage loan business for the recent years. So that's a deal we're paying a lot of attention to going forward this week.
All right, David, thanks so much. We look forward to your reporting on this in the days to come. All right, well, coming up, we are talking about the sell-off on a Monday, the tech-driven sell-off, and maybe the implications there for the ETF sector. We've got that for you when we come back. ETFs pegged to NVIDIA took a steep losses in Monday's DeepSeek-driven tech rout. Now, they've since recovered some ground, but this week's tech rout could potentially be prompting investors to look beyond the Mag 7. Here with this week's ETF report brought to you by Invesco QQQ. We want to bring in Todd Rosenbluth. He is head of research for TMX Verified. Todd, it's great to have you back here at the desk. Let's talk about the sell-off that we did see on Monday. Was it a wake-up call for investors?
I think it was a wake-up call. We've seen a lot of money going into single stock leverage ETFs. You mentioned tied to NVIDIA. We've seen a lot of money going into those mega cap growth oriented strategies. We think this is a good time for investors to remember diversification and diversification benefits. So artificial intelligence is a mega trend theme that's going to resonate not only in 2025, but beyond. There are more diversified ways to get exposure using ETFs. The Robo Global Artificial Intelligence ETF, the ticker is THNQ or THINK, is a great way of getting exposure. It owns NVIDIA, but it also owns cybersecurity and software companies. It owns e-commerce companies like Shopify. This ETF held up much better because of its diversification, and we think we're going to see investors embrace those more broadly diversified AI ETFs in 2025.
And Todd, even beyond AI, much of the tech-driven sell-off that we saw earlier this week has reignited this debate over growth versus value, where we are seeing some of those opportunities. Is there a value play that maybe this exposes a bit more?
So we think value is going to have a better run in 2025. This could be a great catalyst for that. The Fed and the actions that are coming up later on today and the environment. American Century U.S. Quality Value ETF, VALQ, V-A-L-Q, is one of those ETFs that's on our radar at Verify. It holds some of those blue chip, high quality companies that you think of, but with a value perspective. So Johnson & Johnson is a name that comes to mind that's in that portfolio. You want to get the benefits of diversification. And so even if you don't want to go all the way to value and you want to still stay core with your large cap growth, an equal weighted strategy. So Invesco has RSP, that's the S&P 500 equal weight strategy. Goldman Sachs has GSEW, also large cap, equally weighted. You can spread the risk around so you're not just focused on NVIDIA and those mega cap growth stocks.
And real quick, Todd, we only have about 15 seconds here, but an event like Monday, how much does that really spook investor confidence, do you see, from a flow perspective?
So we actually saw money going into ETFs. Now people are rotating from within, they're perhaps selling out of the things that are falling the most. But we had a record run for ETFs in 2024. We're on pace. Vanguard 500 VU is about to become the largest ETF because of $20 billion of net inflows already this year.
All right, Todd, always great to have you. Thanks so much.
Thank you.
Much more coming up ahead on Yahoo Finance.
It's time for Yahoo Finance's Market Minute. Stocks are mixed with the Fed decision and big tech earnings in focus, but Starbucks shares are higher amid optimism for the company's turnaround under new CEO Brian Niccol. Starbucks saw its decline in sales ease in its latest quarter, and Niccol telling Yahoo Finance the company is looking for ways to return to growth. And the AI arms race heating up. Shares of Alibaba are jumping on the back of a new AI launch. The Chinese tech company releasing a new model it claims surpasses DeepSeek, OpenAI's ChatGPT-4, and Meta's Llama. Plus, ASML shares surging the most since 2020 as earnings blew past analysts' expectations on solid AI chip demand, the CEO shrugging off concerns that DeepSeek will hurt the advanced semiconductor sector. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we'll talk to a portfolio manager about finding opportunities in the market despite any economic risks or uncertainties. We'll also review 3 steps to building an effective investment strategy. And we're digging further into tax season. We'll discuss the financial benefits of downsizing your home with a tax attorney. Plus, Starbucks pulled back on promotions in their most recent quarter, boosting ticket size for many customers, perhaps you out there. We'll discuss how you can still buy your Starbucks latte or your favorite coffee or sweet treat and still keep it within the budget for those little luxuries that you have every day. But first, we take a look at some of the market action. We're 90 minutes into the trading session. Stocks, they are mixed ahead of the Federal Reserve interest rate decision. That is due out at 2 p.m. Eastern time today. Joining me now, we've got Joanne Feeney, good friend of the show, Advisors, Capital Management Partner, and Portfolio Manager. Joanne, great to have you back. You see economic risks ahead this year. How can investors hedge against those risks and secure income?
Yeah, good morning, Brad. Well, it certainly could be a challenging year. We've had a couple good ones. The risks, I think, most people recognize are, will inflation continue to come down? We have the Fed meeting today, and they're likely to do nothing with interest rates. But the other big risks, obviously, are on the fiscal and trade policy side, right? We don't know exactly what tax rates are going to be, personal tax rates, corporate tax rates. There's certainly been a lot of talk about raising tariffs on some of our largest trading partners, which will raise costs to consumers and to firms that need to import intermediate inputs to build their products. And then there's the budget deficit and the debt. We have a very strong economy, though, at the moment, and there are no current signs that we're heading to a recession. Nevertheless, we think it's wise to build portfolios with some resilience in them and potentially to build in some income so that when you do need cash off your portfolio, you're not forced to sell shares when and if shares happen to be down.
You mentioned the Fed decision coming today. Of course, this is the first of 2025 here, and we're not expecting cuts until what seems like the midpoint or even back half of the year here. So all of that in mind, what is the tenor that you think Fed Chair Jay Powell will strike once the decision is made, and ultimately how the markets may receive that?
Well, I think he's going to dodge and weave to try not to answer too many specific questions. I mean, the Fed is in a difficult spot. They and everyone else knows that major policy changes are coming from this administration that could very well put upward pressure on inflation. But the Fed can't really act ahead of that. They're going to have to take a wait-and-see attitude, and I believe that's what Chair Powell will convey today. And so the pause in interest rate declines will, I think, be clearly communicated, but they'll also say, obviously, that they're going to wait and see how policy evolves and how data continues to come in on the inflation front.
We're also going to get a little bit of their read-in, of course, on the consumer, too, as we kind of evaluate and as we can through earnings reports and how companies are talking about the state of the consumer. What do you believe the Fed's estimation of how long the consumer can continue to weather some of the longer run inflation, even though it's not at the highs of the cycle? Of course, they're still trying to get to that 2% target, and it's been running above that for some time now, even though we've been in and out of this 2 handle.
Yeah, I think there's a number of ways the Fed may very well look at the consumer. First of all, one of the most telling measures of consumer spending health is the real personal disposable income that is adjusted for inflation and after taxes. How much income do households have? And it's been growing year over year. And so that tells you there's more spending power, that consumers can fit and walk out of the store with more stuff in their baskets despite the increase in prices. The other side of the consumer equation, though, is what's happened to housing costs. Rents are up, and that also puts pressure on the consumer budget. So, I don't expect the Fed to make a lot of specific forecasts regarding the consumer, but I do expect that they're going to give us an update on their view of the health of the economy, and I suspect that that view is going to be pretty solid.
What would be the top trade emerging from their assessment of the health of the economy that comes to mind for you?
Yeah, I hate to disappoint, Brad. I don't think there's going to be a lot of trading information that comes out of this meeting. I think everyone pretty much expects no change in rates. The Fed will affirm the strength of the U.S. economy, and the Fed will confirm that they will be, in a holding pattern until they learn more about this administration's efforts on the trade and fiscal front. But that doesn't mean investors should be complacent, right? If you haven't looked at your portfolio in a while and you haven't perhaps become as diversified as you should be, early this week's moves in technology stocks, energy stocks, industrial stocks should have been a wake-up call. It's really important at this point not to have a portfolio that's too concentrated. And if you do need to use some of that portfolio, if you're using it for income, then it's really important to build in some solid income-generating stocks, whether it's pipelines or some of the pharmaceuticals. There are a lot of places to look for income that can help shore up a portfolio during particularly uncertain times, which I do believe is where we are now.
And so with that in mind, and just lastly, while we have you here, Joanne, it seems like the Fed, even in this wait and see, they're waiting to see how the broader economy ingests some of the policy movements, whether that be on mass deportations, whether that be on tariff policy as well. And so that considered, is there a tariff hedge or a mass deportation hedge trade that comes to mind or that you're advising?
Yeah, I mean, you raised one I missed out on there, Brad, the mass deportations. We'll have to see just how quantitatively impactful that could be. Obviously, if it were, it would raise wages, particularly among those working in construction, agriculture, and leisure. And so one has to be wary of the cost pressures such companies could face. And that's an area we are certainly examining. The other side is the tariff front, which will make it more expensive for cars, U.S. car companies, for example, to build cars. We've seen that in GM stock recently. So one way to work around that is to try to own companies that are more domestically focused, that aren't so heavily reliant on an international supply chain. That's kind of hard to do. We're a pretty global economy, but still, there are places that one can go. And also to find companies that will be more resilient if the consumer is particularly hard hit by these tariffs, which will raise their prices. So companies that offer bargains like a TJ Maxx or a Target might be someplace to look. And don't overlook technology. Even though it's been volatile, it's still a good, solid, long-term growth driver for most portfolios.
Joanne, thanks so much for taking the time here with us today. Really appreciate it.
You bet.
Don't miss special coverage of the Fed's January policy decision at 2 p.m. Eastern Time on Yahoo Finance, followed by Fed Chair Jerome Powell's press conference at 2:30 p.m. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk a little bit about VF Corp, the parent company to brands like Vans, got my Vans on, but they look like sneakers, North Face, and Timberland, seeing its stock rise on a top and bottom line earnings beat. Right now, flatline just barely to the upside. Revenue climbing 2% from the year prior, and the apparel maker also boosting its 2025 fiscal forecast for free cash flow, that FCF, for $440 million. That's what they're looking for from that prior guidance of $425 million. The results are a positive signal for the company's turnaround plans. Next up, let's talk a little bit about the materials and tech company, Corning. They beat on the top and bottom line in the fourth quarter. Core sales, they grew 18% from a year ago. The outperformance driven by adoption of Gen AI products, which drove sales growth of 93% from a year ago, accounted for under its optical communications enterprise business. The business also forecasted a profit range for Q1 where the midpoint is higher than estimates. And lastly here, the pharmaceutical firm Teva is sinking after missing its 20 2025 full-year forecast for adjusted EBITDA. Tiva sees $4.5 billion to $5 billion below, and that range is below the $5.28 billion that they had estimated here on consensus. Fourth quarter revenue just beat expectations, with profits coming in line, and overall sales were driven by the company's generic drugs. Although JP Morgan says U.S. sales were weaker than expected, with much of the revenue upside driven by Europe. JPM says it expects investor debate to center on the stock's catalyst path from here. Those are some of our trending tickers that we're tracking for you today. Well, whether markets are up or down, it's important for you to stay invested in order to build wealth. And our very own Carrie Hannon joins me now with a 3-step investing strategy. We love our listicles here. So first, define your risk tolerance and then set your asset allocation and rebalance your portfolio. Those are the 3 here, Carrie. So let's start with step 1. How does one define their risk tolerance?
Yeah, Brad, this is a great question because it's really how much you can stomach when the markets drop, right? I mean, are you going to freak out? Are you going to panic? So, one way to look at it, this is sort of this moment where you have to sort of take a breath and really be honest with yourself. How can you handle the drops? And we see these all the time, and can you wait it out for it to come back? So you look at if a 10% drop is going to make you crazy, then you're not very risk tolerant. If 20%, moderate. If it's 30%, then you're pretty tough out here, and you'll let it ride. But it's important to understand that before you start, investing, because this is going to tell you how much you want to be in the stock market, invested in equities, or in cash and bonds, which is a little more steady, and you're not going to have these ups and downs.
What about setting your asset allocation? How do you go about that?
Yeah, this is an important piece of how you balance between stocks and bonds. And when I'm talking about equities and stocks, this can be, divvied up into international stocks, small caps, all across the board, how you break down that piece of it. But you need to look at a couple of things. You need to look at what is your time horizon for this? When might you need this money? Secondly, again, what we just talked about, what is your risk tolerance? And the third one is really, what are your financial goals? So if you're nearing retirement, you're going to have a different outlook. But basically, I like to tell people, take 110 minus your age, and that's how much you should have in equities.
Interesting. Okay, and finally, rebalancing. That's very important. You got to look across your assets, and especially if you're investing for retirement, what tips do you have for rebalancing?
Yeah, Brad, what I love about rebalancing is, guess what? This is something you actually can control. You can't control some of these swings, but you can control how much you have in your balance. So I like to tell people, if you're between 7 and 10% away from what that initial asset allocation you came up with is, now's the time to take some tweaks. You might just do a little, and often it might just be once a year, or it might be twice a year. But take a look and see how far you've moved from what you originally, or have you changed? Are you more risk averse or less? And so I often, again, it's helpful to work with a financial advisor and this kind of thing to help you figure out whether you need a big shift or just a little tweak.
Absolutely. Carrie, thanks so much for breaking these down.
Thanks, Brad.
Appreciate it. Coming up, everyone, what the Fed policy decision today means for your money. We break out how the Fed funds rate impacts your savings account and your mortgage rate. Plus, Treasury yields are falling as investors await that rate decision. We're talking about where the 10-year yield could be heading. Stay tuned. Federal Reserve policymakers will almost certainly hold that benchmark rate steady at their meeting later today, though some investors believe several rate cuts remain on the table in 2025. Maybe not several, but a couple. How do rate decisions and how those rate decisions impact your personal finances? That's the big question. Joining us now to discuss, we've got Molly Moorhead. Molly, great to have you here in studio with us. Let's start perhaps with the most simple form that everybody has some type of exposure to, which is just checking and savings accounts.
Yeah.
So how does the Fed's decision impact interest rates there?
Well, the accounts that pay the best interest are typically high yield savings accounts. And if you have one of those, you probably remember most of last year in 2023 when rates were really high, you were enjoying, 5%, over 5% interest on your high yield savings. And so when the Fed lowers rates, your bank account interest is going to follow. It's not a direct relationship, but there's kind of a trickle-down effect. And so now, with the Fed widely expected to hold rates steady, those interest rates are not going to change a whole lot in the immediate term, but they do track, eventually kind of track what the Fed does.
Interesting. What's the relationship then between mortgages and interest rates?
So this one's pretty interesting to me. Little nerdy, but interesting. So mortgages closely follow Treasury yields, government bonds, and Treasuries move on what the Fed is expected to do. Again, we're talking about a likely pause on rate cuts today, and that is already priced in to Treasury. So the yields we're seeing now are reflecting what the Fed's going to do later. It hasn't happened yet, but it's expected. So mortgage rates are hovering around 7%. They're not likely to come down because of this Fed decision. So the thing to watch for is what signals does the Fed send about future rate cuts, because that will move Treasuries and then mortgages will follow.
Absolutely. All right, a lot to track. We've got a few hours until that 2 p.m. marker where we get that decision, and of course, the 2:30 p.m. press conference. Molly, thanks so much for joining us.
Thank you.
Absolutely. Well, Treasury yields ticking lower ahead of that aforementioned Fed January policy decision. Out at 2 p.m. Eastern Time, 10-year yield, you're seeing it there on your screen. It's sitting just at over 4.5%, it looks like, and the Fed widely expected to hold interest rates steady today. Our next guest says that the question now becomes, are we going to see future rate cuts this year or not? Here with more, we've got Kevin Flanagan, head of fixed income strategy at Wisdom Tree. Kevin, great to have you back here with us on Yahoo Finance. So let's begin there. How are we anticipating that this decision, but also what the Fed says and their tone for the future, also gives us a way to look at yields and expect to understand how yields may move off the back of that?
Yeah, thanks for having me. Great to be here. The way to look at this, just like Molly just said, what's already priced into the market. So what's priced into the Treasury market, the 10-year yield, is that the Fed is not going to cut rates today. What is the forward guidance, though? What will the chairman say at his press conference at 2:30? We believe he'll continue to leave the door open for potential rate cuts, talking about a less restrictive policy, maybe at some point getting to neutral, but no urgency or no rush to get there. And I think in the environment we're in, that's important because we need to look at some relationships. In other words, what is the spread or the difference in yield between Fed funds and the 10-year Treasury? Historically, going back 40 years or so, it's 130 basis points. We're only about 20 basis points right now. So even if you gravitate towards, say, 100 basis points, a full percentage point from where we are, and the Fed cuts rates 1 or 2 times this year, you're still talking about a 10-year Treasury yield that's probably headed back towards 5%.
And so with all of this in mind, for investors who are laser focused on where their fixed income exposure is, how should they be thinking? What approach are you recommending right now?
Well, we've been talking about, the classic barbell approach for a while, with the cornerstone being Treasury floating rate notes, which is interesting because oftentimes people hear floating rate notes. Well, that's a rate hedge. Well, not Treasury floating rate notes. What we've been seeing there is you're taking credit out of the equation. It's just 100% Treasuries. It's tied to the weekly 3-month T-bill plus a spread. So you're yielding right now somewhere around, say, 4.4% without the volatility that you'd be getting in the broader bond market. Remember, that 10-year Treasury yield we were just talking about, mid-September was 3.6%, almost 100 basis points below where we are now. So we think a passive active kind of approach to the barbell strategy makes a lot of sense.
Kevin, thinking about even in the absence of a cut at this meeting or the next few meetings, then how much more focus does that put on QT, quantitative tightening, and what the trajectory is there that we hear from the Fed and how that could pass through to yields?
That's a great question. No one talks about the Fed balance sheet anymore. But what's interesting, as the Fed cut 100 basis points in the fall of last year, they're still reducing their balance sheet. In other words, the pace of what they had been buying in treasuries and mortgage backs. And I think it's a question of when, not if, that QT, this quantitative tightening, is going to end. So what you're going to be looking at then in that environment is that less restrictive Fed policy, not just on the rate front, but also in terms of their balance sheet.
Kevin, thanks so much for taking the time here with us today. I really appreciate it, and great breakdown on the correlation here that we're going to be tracking, not just at this meeting, but of course going out into the rest of the year. Thanks.
Thank you.
Certainly. Don't miss special coverage of the Fed's January policy decision, 2 p.m. Eastern Time on Yahoo Finance. We're going to be following that up with Fed Chair Jerome Powell's press conference at 2:30 p.m. Eastern Time. You don't want to miss it. Well, coming up on the other side of this short break, we're discussing why you might want to add crypto to your retirement portfolio. That's coming up. Let's get a quick check of the markets here as we are just about 2 hours into today's trading activity. Take a look at the Dow Jones Industrial Average, flat just barely to the upside here. This is after we were seeing that kind of teeter-totter waffle, if you will, between gains and losses to start off the day. And we're taking a look at the Nasdaq Composite as well here. Right now, fractionally declining by about 0.6%. S&P 500 down by about 1/3%. Let's go a little bit deeper into the tape right now, though. Taking a look at the sectors, we'll begin there with the 11 S&P 500 sectors. We got them pulled up on the screen. And XLK, technology, that's leading the declines as of right now. XLK is down 1%. You got more good news than bad news, though, here. Let's take a look at communication services that's leading the pack. You've got more laggards, or more leaders than laggards here on the day on the sector basis, at least for the 11 S&P 500 sectors. And communication services is up 0.6%. Since I mentioned technology a moment ago, let's take a deeper dive into the Nasdaq 100, some of those mega cap tech stocks. You're seeing NVIDIA pulling back here by about 4.5%. Of course, those would be pulling back from some of the gains that we had seen yesterday, but those gains were really just to try and offset the deep declines that we saw for NVIDIA in its worst market cap wipeout single session to begin the week here. So here on the day for NVDA, we're seeing shares lower by about 4.5%. We'll continue to track all of these moves here throughout the trading session and give you some more updates going into that key Fed decision at 2 p.m. Switching gears, in 2024, 35% of Americans felt like they were significantly behind when it comes to saving for retirement. That's according to Bankrate's retirement survey. Now, one asset that you may not have considered adding to your retirement portfolio, cryptocurrency. Joining me now in studio with more, we've got Chris Klein, who is the COO and co-founder of Bitcoin IRA. Chris, great to have you here in studio with us. Now, you say that there are 3 things that typically draw investors to crypto. So let's start with asymmetry. Why is that appealing?
Just getting yourself as a potential hedge against other problems in the marketplace. Also just getting off of zero and having an opportunity. This is a big shift in monetary policy that's happening. And for the first time in about 100 years from the White House, we're getting executive orders that are saying, hey, this is time for national sovereignty and for individuals like yourself, individual sovereignty with your portfolio.
You're also looking at this as an inflation hedge. That's part of the top 3 things that you're looking for and reasons why investors tend to turn to Bitcoin for retirement saving. Just break that down for us in the inflation hedge that Bitcoin could be for retirement savings.
So it comes down to scarcity. There's only 21 million Bitcoin that'll ever exist. 19.5 million of them are accounted for. We haven't seen this kind of scarcity since the 1920s, 1930s. So to get, there'll be a day where they'll say, wow, you're a 1 Bitcoiner, and it'll be a life-changing experience for those folks.
Interesting. And lastly, within that, volatility and hedging against volatility. I mean, Bitcoin and crypto more broadly initially and continue to be known as a more volatile asset. So how does having and gauging that volatility, how does that work within a retirement strategy?
Well, you're more of a long-term thinker, or as we call long-term hodlers in the crypto space. So when you're in your retirement setting, you're thinking 3, 5, maybe even 7 to 10 years out. But volatility is a reality walking in, and especially this year, we're going to have price discovery. Tom Lee and others are calling for maybe $200,000, $250,000 for a Bitcoin. We're sitting just around 102 today. So as we reach each of those new zones, expect more volatility. But it's part of the process, and also downline, we have about 80 currencies on our platform. So you've got Ethereum, it's going to have its growth, and other tokens.
And so we've got kind of 3 buckets of investors that we're also looking across, or retirement savers that I should say we're looking across here too. You've got the risky, you've got the moderate, and then you also have the what could be called the crypto curious or the risky curious or the conservative retirement savers out there as well. Within all of those buckets that we lay out here, how do you kind of break them down and ultimately give them perhaps a roadmap?
Absolutely. Well, one thing to point out is we found that 75% of our clients were born before 1976. So it's not a young man or woman's game as most folks expect. When you're looking at your risk aversion or your risk tolerance, getting off zero is just critical. So you don't want to be left behind when it comes to the cryptocurrency or Bitcoin revolution that's taking place. I think a big thing is just to look at your contribution for the year. You can do up to $8,000. What a great plan, what a great place to get off zero and get started in a very small fashion.
You know, while we have you here too, there's been so much focus around a strategic Bitcoin reserve here. How does that need to be built out in order for it to benefit holders, holders of Bitcoin and retirement savers too, who are now using this as a key asset for building wealth.
You go back to the scarcity first. We've been talking about the reserves since July at the Nashville conference, where Senator Loomis announced that she put legislation up. This is, he who holds the gold makes the rules. He who holds the Bitcoin will play by the new rules that take place. So you have nation states like Bhutan, Argentina, El Salvador, the United States, others that are announcing they're going to accumulate a piece 1 to 5% of their GDP. And then you have individuals and institutions that are saying, okay, well, if we're going to put on the balance sheet for the country, I better have it on the balance sheet for me as an individual household owner. Because if you think about the country, you have a lot of debt. You've got high rates for that, maybe going down, but probably not today, but maybe going down in the future. And you've got to balance that out with hard assets. As an individual, the same thing. We carry debt, we carry mortgages and other things. This is a hard asset that you can have to balance out your portfolio.
And so how does this play out in policy? What do we need to see come from either the White House or the SEC within that?
Well, first was the executive order was very welcoming. First executive order in 100 years that actually celebrated individual sovereignty in this country. If you go back to FDR's confiscation of gold in the 30s, you go to Nixon in the 70s where they took us off the gold standard, this is the first time where individual sovereignty is being applauded in an executive order. But they don't make the laws. I mean, we all know I'm a bill on Capitol Hill, right? We remember that. So it's got to go through Congress. I think it's going to be spearheaded by the subcommittee, and we'll get some legislation. I would probably in this probably by April or May we'll start seeing what this is actually going to look like. But in the meantime, average Americans don't have to wait. They can get off zero today.
All right. A lot of people who had Schoolhouse Rock on their bingo cards at home celebrating today. Appreciate it, Chris.
Thanks for having me.
Thanks. Well, to the extent permissible under applicable law, federal agencies must temporarily pause all activities related to obligation or disbursement of all federal finance and financial assistance. That's a quote from a memo issued by President Trump's Office of Budget Management and Budget yesterday. The order was halted by a federal judge who granted a temporary stay until Monday, February 3rd. Our own Jordan Weissman is in studio. Jordan, what is exactly behind this order?
Well, just stepping back, it was a wild day in Washington yesterday. Nobody knew what was going on. It was a bit chaotic for reporters, for members of Congress, for anybody who was expecting to get money from the federal government. But essentially, the Office of Management and Budget sent out this memo saying you have to freeze federal funds for all sorts of grant and loan programs. The problem, and if you listen to the Trump administration, what they're saying is this was meant to target a relatively small number of programs involving things like diversity, equity, and inclusion, which of course they've been targeting, climate, things like that. However, the memo was not that specific about exactly what was going to be targeted for being temporarily shut down. So this left people with questions like, are my student loans going to be dispersed? Is Medicaid going to be paused? And then on top of that, the website that state officials use to essentially deal with Medicaid to get their funding, that all of a sudden was on the fritz. They couldn't get access. So this led to what you might say a bit of a panic throughout all of DC yesterday.
Yeah, certainly. We saw some of that panic playing out on social media as well. We're showing a post from Ron Wyden. And additionally here, there is a question about the programs that will and won't be affected by this. Do we have any clarity around that?
Well, I think what we've learned at the end of the day, first off, they essentially walked back a lot of people they appeared to walk back the initial memo, or at least clarified the official memo with a long Q&A towards the end of the day, where they said, no, anything that gives direct benefits to individuals is not going to be affected. Medicaid will not be affected. Student loans will not be affected. Pell Grants will not be affected. It's still left up in the air what would be affected, and people are still trying to sort through that. But I think the general rule of thumb is that your personal finances are probably not going to be hit by this order, or at least not in the immediate future. People who do have to worry is if you run maybe a nonprofit that provides housing to certain groups. Certain charitable organizations might run into trouble. But for most Americans, this is probably not going to mean anything in the near future.
Jordan, thanks so much for joining us, breaking this down. A lot of questions still to be answered right now.
Thanks for having me.
Definitely. Coming up, everyone, you might be able to file your taxes for free if you live in certain states. Plus, we've got advice on how to downsize without increasing your tax bill. That's all coming up next on Wealth. The Internal Revenue Service, known in your hood as the IRS, expects 140 million Americans to file their taxes ahead of the April 15th deadline. And it wants millions of those filers to consider using its Direct File program, which allows Americans to file their taxes online for free. There are several changes to Direct File this year, starting with a massive expansion in who can use it. And the program is now open in 25 states, up from 12 in 2024. Taxpayers in Illinois, New Jersey, New Mexico, North Carolina, Pennsylvania, and more are now eligible. And that's not the only change coming this year. Direct File now covering new tax forms. Taxpayers now use and can use Direct File if they have the Child and Dependent Care Credit, the Premium Tax Credit, the Tax Credit for the Elderly and Disabled, and Retirement Contribution Credits. The program also has new features, including a tax data import tool that can automatically add your W-2 and Social Security number, a feature you may recognize from paid tax software services like TurboTax. The Direct File also has a chatbot available in English and in Espanol, as well as the option to opt into additional authentication and verification options. And if you don't live in an area covered by Direct File, then you may still be eligible for free tax preparation software through IRS Free File. Taxpayers who make less than $84,000 per year and who file the most commonly used tax forms qualify. You can go to irs.gov and search for Free File to sign up. More than half of retirees downsize their living situation once they retire, according to Senior Living. But there are plenty of logistics, namely taxes, that can impact the process. Joining me now, we've got Adam Brewer, who's the tax attorney at AB Tax Law. Great to have you here with us. So when downsizing, retirees, they might be headed to a different state altogether. You talk about this in some of your notes here, mentioning the Tax Cuts and Jobs Act, known as Trump's tax cuts, accelerating a shift from high states to low states. Could you tell us more on that and why that might mean some changes for folks' tax bill?
Yeah, absolutely. Good morning, Brad. So quite a lot to talk about there, but I guess the central point is if you're a retiree looking to downsize, don't take the tax side of things lightly. It is a complex mix because we're talking about income tax, we're talking about retirement, we're talking about property tax, and we're also looking at inheritance tax. So we got a lot going on, and then you're talking about possibly 2 different states or 2 different locations. So definitely something that if a retiree is looking to downsize, they really look at the tax side of things because it's not always going to be clear cut. Where I'm at in California, Prop 13 means property tax for people who have been in their home a long time is generally pretty low. I know that's not the case in every state. So definitely something that retirees looking to downsize should take seriously.
And so with that in mind, what are the benefits to renting versus buying your new downsized residence in retirement from a tax standpoint?
Yeah, so that's something I touched on in my notes. And essentially what we're looking at is there is a shift, of course, I don't want to say Rust Belt, but, the Rust Belt states where I'm from originally, Pennsylvania, Ohio, Indiana, to the Sun Belt, that shift was always taking place. But the Tax Cut and Jobs Act really accelerated it. So what we saw there is limiting state and local tax to $10,000 as an itemized deduction. So suddenly, what's my incentive to pay a bunch of tax in New York when I can just go to Florida and be tax-free? They limited the mortgage interest deduction, so you can only deduct interest on the first $750,000 of your mortgage. So again, if you're in a high cost of living state, New York, Connecticut, Massachusetts, your home very well could be over $1 million. You're not even able to deduct all that mortgage interest. And then finally, with regards to moving to the low-cost state, there's a higher standard deduction now. And so really a lot of taxpayers, even if you have a mortgage, if you pay property tax, you might not even be using that standard itemized deduction rather.
Now, maybe you're thinking of selling your home back to your kids. What are some of the tax implications to be mindful of in that process?
Yeah, so that can be a good way if you sell it to your kids. You have to be careful about, what is the fair market value of the home if you sell it. If you gift it,
again, the lifetime gift exemption is so high. I think it's $14 million for 2025. Most taxpayers aren't going to run into that. But what their heirs may run into is if they ever decide to sell the property, now they could possibly get hit with a massive capital gains because they're going to essentially be giving up what we call a step up in basis. And so what that is when you pass away, your heirs are treated as if they paid what the fair market value is on the date of death. And so if you gift it, instead your heirs are walking into your basis. So if you purchased your home in 1970 for $50,000 or whatever homes cost then, and now it's worth $1 million, you could be handing your kids a big tax bill that they otherwise might not have.
Interesting. And when going through the downsizing process, how do SALT deductions play a role in the decision making?
Oh, that's a curveball because right now it's $10,000. So again, it's not a huge incentive for taxpayers to be paying their state and local tax, to be paying property tax on top of that. But now we're looking at extending the Tax Cut and Jobs Act, and the SALT is a major point of contention. So I know there's talk of increasing that to $20,000, but then there's some blue state Republicans who say, hey, that's a non-starter for me. So again, in this climate politically, we really don't know where that's going. It could stay 10,000. I suspect it'll be increased, but whether that's enough of an incentive for taxpayers who are retirees who are getting hammered on property tax, that's tough for me to say.
Just lastly, while we have you here, it is tax season. Sticking with taxes, the Trump administration has announced a federal hiring freeze and offered incentives to federal workers to quit their job. To the extent and your estimation that you're kind of looking through this, what does this all mean for the IRS more broadly and Americans filing for their taxes this season?
Yeah, absolutely. So it just reiterates a point that we've been talking about for a while, and that is if you can electronically file your return, whether that's through the IRS free service you just discussed or whether another service, if at all possible, electronically file that return. This isn't a situation where you want to be waiting on the IRS to open your envelope, process a paper return. It's just going to take a lot longer than you hoped for, especially if we see IRS employees retiring, if we see other processing slowdowns. Get that in electronically, get your refund faster. Yeah, and then the other taxpayers that are going to suffer from this, sometimes things just don't go right when you're processing a return. So anybody who has to have like a second point of contact with IRS, calling them, everyone knows how difficult it can be to get on the phone. That could possibly be a lot more challenging.
Adam, thanks so much for taking the time here with us today. Appreciate it.
Yeah, thank you. Great to be here.
Certainly. The Consumer Financial Protection Bureau is releasing new data examining the continued challenges that renters face in the U.S. Joining me now on set with the breakdown, we've got Yahoo Finance senior reporter Claire Boston. Claire, the rental data accounts for the last 3 years approximately here. So one of the notable call-outs is the percent of renters paying late fees. What are we seeing there?
Right, Brad. We're actually seeing some pretty good news in terms of who is paying late fees, which is a pretty good proxy for overall delinquency. Just 14% of renters were paying those late fees in 2024, and that's down from more like 23% in the beginning of 2023. That puts us back toward levels we were seeing during the pandemic. And what's interesting there is during the pandemic, there were a lot more types of support available for renters. So overall, pretty good news.
So the CFPB also BP, I should say, also has data on mortgage delinquency rates. This can be an early indicator, as you were mentioning, of the mortgage market's overall health. So capturing buyers missing 1 or 2 payments, what do we ultimately see there? What can we extrapolate from that data?
Right, so mortgages are quite interesting to me because we are actually seeing something a little bit different happen. We are seeing more people go slightly delinquent on their mortgage payments. These days, mortgage delinquencies are up to about 1.4%. That is far, far below what we saw in 2008 during the recession, but it is about double than it was a few years ago. And so, what might be happening here is just it's really expensive to own a home, and people are under financial stress.
So, Claire, there seems to be some diverging narratives here. On one side, you've got mortgage delinquencies getting worse, but then you've got Rental data seemingly getting better. Why is that?
Right. I think really we talk a lot about rent versus buy calculation. Homeownership is kind of the dream in America, but it is very expensive. Insurance costs are rising, mortgage rates are up. When people have those higher payments, if they then run into trouble, it can be harder to, come up with a way to make that mortgage every month. And when we see someone go delinquent for a few months, we typically think of that as a sign of early financial distress.
Claire, thanks so much for tracking this data, drawing, of course, the conclusions coming off of it too. Appreciate it.
Welcome.
Coming up, everyone, are sweet treats blowing your budget? I'll talk to a money-saving expert about how you can fit those little luxuries into your monthly spending. What's next? A programming note on a new episode of Trader Talk with Slatestone Wealth's Chief Market Strategist, Kenny Polcari. We've got Sylvia Jablonski, Defiance ETF CEO, on to discuss if the quantum computing trade is just getting started.
Nobody can predict whether or not quantum computers are going to be, flawless and work really well in 3 years, 5 years, 10 years, or 15 years.
Right.
The same way we can't predict whether all of the AI, inputs are going to work.
And to your point, who thought even a year ago that AI would be where it is today?
Right.
And the way that people are using AI, right? I mean, people are using ChatGPT and Magi and all these other ones in ways that they probably never even imagined when we first started talking about these names. But now it's like second nature.
And the world has actually changed because of it. Like if you look at ChatGPT, when you had initially started to use it, like it was error ridden, right? You couldn't really rely on it for everything.
Right.
Now it's pretty good.
It's pretty good.
It
is pretty good.
You can watch Trader Talk with Kenny Polcari every Wednesday at 12 p.m. on Yahoo Finance or wherever you get your podcasts. We all get the urge to spend on things that we don't necessarily need, like that morning latte at Starbucks or a sweet treat after dinner or a Saturday night movie ticket. So how do you allow yourself those small pleasures while still saving for the future and without breaking your budget? Joining me now, we've got money-saving expert Andrea Warrock. Andrea, great to have you here with us. So let's start with creating that budget. How do you factor in your wants on a regular basis?
Thank you for having me. And yeah, I'm excited to tell you it's okay to spend on those wants, but you really do need to have a spending plan that accounts for these and how much you can actually spend each month without derailing your savings goals or your debt payoff goals. And so a budget, I typically like following the 50-30-20 budgeting rule. This assigns 50% of your budget towards your necessary living expenses. So this would be your rent or mortgage, insurance, healthcare costs. 30% can go to the lifestyle wants like your video subscriptions, dining out, and those types of expenses, and then 20% to savings. And so that might mean maybe you can't afford all those splurges, but you can afford some of those splurges. And then using apps like Rocket Money or You Need a Budget can help you actually track your expenses so you don't go over in any category. They'll actually alert you if you're about to overspend maybe on Starbucks, let's say.
So what about factoring bigger ones like a vacation or an expensive event? How do you adjust your budget for those things while still having that coffee every now and then?
Yeah, exactly. Okay, so again, using that budget or spending plan will help you be really mindful about where each dollar is going. And so you're going to build different savings goals, short-term, long-term saving goals into your budget. But the good thing is that even though a lot of us are living paycheck to paycheck, there could be areas in your budget that you're wasting money unnecessarily. So I would go through each bill, write down each reoccurring expense you're paying, and figure out if there are opportunities to save. This could look like canceling subscriptions you really don't need. Do you really need 4 video streaming services? Maybe you can move down to 2 or 1. Also, reducing those unlimited data plans based on your actual usage. You could save there or go to an online-only wireless carrier. Just bundling services, increasing your insurance deductible. All these small moves can help you save hundreds of dollars on monthly bills so that you have more money to put towards your various savings goals. And then I have a couple of other easy ways to maybe boost your cash flow. There was a study done by GigaPoints that found that the average credit card user misses out on $1,000 worth of cash back each year. That could help pay for a vacation because they're using the wrong type of rewards card. So look at your spending. Where do you spend the most? Find a credit card that gives you more cash back. I like the Bread Rewards American Express credit card because they're giving you an unlimited 3% back on groceries, gas, dining out, and utilities. So that would cover most people's big spending categories. Use that cash back to put towards your savings goals or afford that coffee that you want. Also, any online purchase you're making, use a cashback portal like couponcabin.com. They're going to give you cash back for online grocery orders, takeout orders, travel bookings, pet food. I use this every day. Cash back can then go towards your PayPal account. I earn anywhere from $10 to $70 a month. That's a great little fun fund right there to use towards, a dining out or going to the movies. I also love the Fetch app. This is a free rewards app. You take pictures of all your receipts. They also have a web extension called Fetch Shop for online purchases. This app will then give you points when you upload your receipts or use their web extension. You can then redeem those points for gift cards to Starbucks, Amazon, Target. Use those to pay for your splurges without derailing your budget.
And just lastly, what we have here, I got 15 seconds. How do I eliminate my impulse purchases?
Okay, those impulse purchases really are derailing your savings goals and your budget. So you need to identify spending triggers and figure out ways to avoid them. So let's say you can't resist a sale, then unsubscribe from emails that you get from retailers. Delete those shopping apps. Also, delete your credit card info that's saved in Amazon or Instacart or Instagram, so that you can't buy without thought. Yeah. And every time you have to go find a credit card, you may be able to rethink and dodge that impulse purchase.
Andrea, thanks so much for taking the time here with us today. Really appreciate it.
Thanks for having me.
That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. Don't miss special coverage of the Fed's January policy decision, 2 p.m. on Yahoo Finance.
Endeavor, which will be called Truth-Fi. The cash will be kept under the custody of Charles Schwab, who will also broadly advise on investments and strategies. And T-Mobile shares also rising, on track for its best day since February 2022 after beating earnings expectations and issuing its best start of the year guidance ever. T-Mobile expects to add 5.5 million to 6 million net customers in 2025. Plus, Teva Pharmaceutical shares, they're slipping here on lower revenue and a softer than expected outlook, and that's your Yahoo Finance Market Minute.